morning. It is 9 a.m. here in New York City. This is Yahoo Finance Live. I'm Julie Hyman. That's Brad Smith. Here are three things you need to know this morning. A pivotal week for investors kicks off with a focus on some big IPOs coming to market. ARM could be looking to up the price range of its listing, according to Bloomberg. The public debut of the SoftBank-backed chip designer is set to be the biggest this year. The other listing to watch, Instacart. The business this morning submitted an updated filing for its upcoming IPO. It's looking to raise up to $616 million of fresh capital. Apple very much a focus ahead of its big fall launch. The Wonderlust event expected to launch 4 iPhone 15 models and the Apple Watch Series 9. It comes after shares took a hit last week on what looks like a growing backlash in the world's second biggest economy, China that is. And this morning, some news suggesting plans to build its own modem chip are not quite ready. Qualcomm announcing it'll supply Apple with 5G modems for smartphones through 2026. And J.M. Smucker is going to buy Hostess Brands for $5.6 billion. A tie-up between the maker of Jif peanut butter and the company behind Twinkies marks a landmark deal in the food space. It comes after a year where we've seen sales of snack items holding up well despite price rises and fears of economic slowdown. Hostess emerged as a takeover target amid concerns over declining volume growth. General Mills, Mondelez, and PepsiCo had all expressed an interest in that business.
Well, the first thing that we were watching this week, ahead of its Wednesday initial public offering, ARM is considering asking investors to up its valuation, sources told Reuters. Chipmaker considering raising its $47 to $51 price range for what could be the year's biggest IPO. And in an updated filing this morning, Instacart revealed it set an offer price range of $26 to $28 on the top end, aiming to secure up to $616 million in fresh capital. Now, during the pandemic, a red-hot venture fund raising market saw a flurry of valuation activity, but the Fed's historically aggressive interest rate hikes have put an end to that. There's hope among some investors that ARM and Instacart's impending IPOs will fuel a possible rebound in U.S. listing activities here. And in an interview with Yahoo Finance executive editor Brian Sozzi, Goldman Sachs CEO David Solomon called the market encouraging. Take a listen.
We are starting to see a pickup in activity. As you mentioned, there are some very significant IPOs that are in the market this week. The ARM IPO is progressing nicely, and I do believe that if these IPOs go well, that kind of creates a virtuous cycle of bringing some of the other IPOs that are in the wings waiting to market. And so I do see a pickup in capital markets activity during the course of the fall. I can't say that we'll get back to what normalized levels are, but we're really coming off of, zero activity.
And so even as we evaluate those words from Goldman Sachs CEO David Solomon, it's also with the evaluation of what's already come public to this point. This year, it's been some very specific waiting to get out niche type of plays. Kava had good reception in the market, and there's reason to believe that ARM, for all of the big money that's been invested into it from some of the largest mega cap tech companies in the U.S. already, that it sure could have a warm welcoming by the street. But then there's also some tests that we could still be seeing and faced with some of the other IPOs that are even registered for this month.
Well, and of course, remember, even with ARM, even though if it's pricing shares at the top of the range was lower.
Yeah.
So, it's, yes, the market is opening back up, but it's a matter of at what price. So that is sort of the key here that we're talking about for all these companies. And everybody we've talked to has talked about sort of the circular nature of this, right? If one company goes public and then that goes well, then the other companies sort of follow suit. So that's kind of what we're watching here. And it's certainly not a return to the go-go days of 2021 or, where we saw a lot of demand and it didn't matter kind of the particulars of these companies.
Right.
It looks like investors are going to be more choosy here. And there are still a lot of companies. For all these, we're talking about 2 companies that are big. There's Klaviyo, too, which could come public this year. But, it's not a flood by any stretch.
No, and thus far, based on some of the data from Renaissance Capital, who tracks the U.S. IPO market, among IPOs that are above a $50 million market cap, because there are some small deals that still make their way to the market that come through, the largest industry that's been able to see the most IPOs come forward this year is industrials IPOs. So more than any other sector there. That's important to remember within this broader context, and just goes to show how even among some of those other sectors that are seeing companies companies make their foray into the public markets and listing shares, that they're being extremely judicious about the market that they are entering into, especially given some of the volatility that we had seen in August over the summer here. So now moving through that and getting to a period where hopefully as things start to settle a little bit more, this is where we'll see ARM and potentially Instacart making their way into the public markets here.
Let's talk about Apple as well. Investors there are starting the week off on a positive note. The stock is up the day before the tech giant's annual fall launch event. The star of the show expected to be that new iPhone 15 and its USB-C charging port. They're also expected to unveil a new Apple Watch and AirPods. And as always, it's not just going to be about the devices that they announce, but also the cost at the price at which those things will be priced. We don't always find out the day of what the prices are going to be, right? Sometimes you get that in the days following, but it has really been an interesting strategy that the company has employed in recent years, even as iPhone sales have remained relatively stable or flat, to use a less positive word, I guess. Because they've raised the prices, they've managed to make more money from them overall. So what are the bells and whistles that are going to be on this latest crop? There's some reporting from the likes of Mark Gurman over at Bloomberg that there's going to be a new Zoom feature on some of the highest priced phones. So the question is, what is the upside from the lower price to the higher price? Is it worth it? Are people going to be willing to upgrade based on some of all of this?
Yeah, there's a few tertiary players that could move and have the propensity to move, especially coming during that event as it's taking place. Verizon's been one of those names, of course, that we've seen for the different kind of telecom carriers that will be part of that Apple Day One announcement. There is some kind of secondary look that investors could give to other names that are going to move around this. But as you were mentioning, that Pro line and the pricing strategy, that's going to be key for them in an environment where consumers are in this kind of, as we were discussing last week with the IDC shipments market right now, where shipments are at some of their lows internationally. And so now it's a question of, will the consumer still gravitate towards a computer in their pocket with a heavy compute power, but also it's really just a phone and a camera that you're walking around with. And that camera is where all of these companies try to compete even more, even if they're trying to sell further into an ecosystem here. This is kind of that hub of the broader spokes within that ecosystem.
Right, and obviously the backdrop here is the big drop that we saw in Apple shares last week on these concerns over whether there is indeed a ban, as was reported in China, on government workers and maybe even government-sponsored enterprise workers not being allowed to use iPhones. So that's what really caused the big drop in the shares there. The other interesting news this morning that we're going to get more into later is this news that Qualcomm is going to keep making the Apple modem chips. Apple had been exploring making them on its own, but it seems as like it's very complicated to do that. So it's not yet ready to do that.
Yeah. More complicated than I can do by myself, so I need that.
Exactly. All right, let's also talk about the economic news that is coming to the fore this week. Inflation taking center stage with the highly anticipated consumer price index that is due ahead of the Federal Reserve's upcoming policy meeting that's scheduled for September 20th. Inflation data coming this week, key to the Fed's decision on whether to keep rates higher for longer. Concerns are growing about rising energy prices and their potential to keep price pressures hot, at least on the headline. On the core, we're expected to see not really any change in the rate of inflation. Here to weigh in on all of this is Ben Amons, New Edge Wealth Senior Portfolio Manager and Head of Fixed Income. So Ben, as we look towards CPI this week, headline expected to accelerate, core expected to remain the same at a rise of 0.2%. What do you make of these numbers and whether energy is going to start to bleed into that core number?
It could be, Julie, because, if you looked at that PCE number that came out the other day, which is the Fed really looks at, there was some pressure of energy appearing, a little slippage into that core number, and that services PCE number that people are now having to focus on, because that's what the Fed told us, that was stickier than before, like a little higher. So I think for tomorrow, the CPI data may show similarity there, and that keeps people on alert. Like the Fed wants to at some point put policy on hold, and that seems to be the tone coming out of the Fed from last week. But it's not a hold that is going to be extended because of this unique situation around CPI and core PCE. If you're getting a strong economy with energy demand, it keeps you headline elevated, and if that stays elevated, eventually it does spill over back into the core. That's been that way as long as CPI has been in existence. So the Fed stays, I think, cautious here as it comes to inflation.
Where should this report also show signs of continuity in order for the Fed's job to, for them, I guess, hopefully be a little easier once they get to the next meeting?
It's still that story about this so-called disinflation. Last year we peaked in inflation and we've declined really nicely down. And that was a really good decline because it didn't lead to any recession and the unemployment rate stayed very stable. Now, if that disinflation stops and we sort of like maybe pick up in inflation again, it makes it difficult for the Fed. But if you're getting a reverse situation of disinflation accelerating to the downside, that would be really a signal of economic weakness. So at the moment, I think we're very steady and stable in the economy. And that's why that disinflation is sort of grinding to a halt. But we have to watch it. If it does pick up again, meaning inflation going higher, then the Fed doesn't have any choice but to continue to put a message out there saying we have to raise rates perhaps even higher than where we are today.
So when we look at this backdrop for stocks right now, and we look at the history of Septembers, where do we stand from an investment perspective, right? Things have been a little rockier lately. Tech stocks in particular have seemed a little more vulnerable to those higher rate expectations. So how do you put it all together?
Yeah, it's a traditional weak month from a seasonality point of view. I guess it has to do with rebalancing, or it has to do with just that it has been historically that way. So people look at these seasonals. I would point more to October. That's much more of a difficult month. But I do think we're at a juncture here where the macro forces are shifting once again. We've got news out this overnight out of Japan that they continue to look at changing their policy. That's a big macro factor. The stimulus in China is getting through their system. They're increasing lending to the economy, and CPI is back out of deflation. So it does show there's some traction there. So I think the September month could perhaps be volatile as October, but it is all about the economy. It's really about what we're going to have this week too on display. Retail sales, CPI and PPI, with this UAW strike perhaps hanging over all of that. That's the macro that drives the markets. I think this is what we're going to be in for in this month in terms of volatility.
And you've been urging caution in terms of investors that are perhaps looking at some of the more riskier assets that they would have kind of leaned towards in the past. And not so much that the Nasdaq 100 is risky, but at the same time, technology as a whole had been under a little bit of fire, at least during the month of August here. So kind of coming out of that, where would you kind of continue to urge caution among investors?
Yeah, you would take into account the valuation. Right? We are at multiples that are high again from the 2021 levels. And so that makes people cautious if you have interest rates sitting here at the top of the range in the 10-year. Right? And that, I think, is where the tension is, that if there is the risk that we are going to break out with rates higher, which is possible, given where the economy is or what Japan is doing, these multiples will contract. That's the mechanics. And I think because we had such an incredible drive of the stock market by just a handful of stocks that are now at excessive multiples, yeah, that continues to be the risk for markets that does reverse, that we're getting some, let's say, mini repeat of what happened from 21 into 2022. I wouldn't call that we go back to that bear market sort of analysis. I think that's not there because the economy has strengthened since last year. It's actually got better. Ever since Powell had his big speech about hawkish and pain, the economy has only improved. So that's reflected in the stock market. I don't think that story has changed, but it's a valuation issue, and that's why we're cautious.
So what does cautious mean for you then? Does it mean hold on your technology investments, don't add, don't subtract, and just kind of hang out right now?
I think that's right, Julie. I think you do not want to increase your exposure at this point. As you take the Apple story as a good example, as you just highlighted, it came completely out of nowhere that China suddenly puts this news out there of this ban, at least it's purported. It doesn't mean that people are stop using iPhones in China, but the market extrapolates it as this is for future revenue of Apple a problem. And so you cannot really discount those factors with too much of like a complacency just because this new iPhone comes out with all these gadgets and fantastic. We are dealing with high valuation for tech stocks, and you're dealing with macro factors. So I think you don't want to add here, but you don't have to outright sell either. These companies are really, really profitable. So I don't think there's a reason to detract from your position.
In your notes, you had some interesting song references. You also had something that was described as a gimme shelter. What is exactly a gimme shelter from your perspective, and how investors could be evaluating that too?
Yeah, the gimme shelter is about sort of like, you can hide in a certain area of the market and kind of gives you that protection. Mm-hmm. But you have to be careful of these dynamics I just described. I had noted actually that the market has been interestingly looking at downside protection again, because we're in such a low volatility environment, and it's now sort of pricing that the upside for markets is less in the options market, priced in less than the downside. So you want to be interesting that you're seeking sort of shelter in a market where there's underneath a change of sentiment perhaps happening. So I think, again, be mindful of that. This is a very fluctuating macro environment where we just don't really know actually where we're heading. We don't know what the peak in rates will be. We actually don't know if we're going to go lower in inflation either. And we certainly don't know if the labor market will soften so much as people think it will. So I think we're in seek the gimme shelter, but take notice of what's happening underneath the market.
I don't know if you'll get to the new Stones album, right? Hackney Diamonds, or is that just the sing? No, it's the whole new. After Gimme Shelter, we'll look for Hackney Diamonds in an upcoming note from you. What does Gimme Shelter look like, though? What does shelter look like in this environment? Do you go into classical defensives? What do you do?
Yeah, you would initially be almost naturally inclined to go to what people say, like we have T-bill yields that are about the same as a corporate bond yield and as the earnings yield on the S&P. It's completely converged, so you can always be indifferent, but the T-bill gives you all this liquidity. I say, well, that has to be an annualized rate. No, it's not that you're going to get that guaranteed. So I think that you're going to stay in this market like relatively well positioned in terms of risk, because it is a good earnings. So far we have seen good earnings and we've seen a good economy. On the other hand, there's some sectors that have really lagged. Energy was one of those that has now started to gain traction. We think there's opportunity. The financials have very lagged because of the regional banking crisis, which has not played out so negatively for the economy, so there's opportunity. And then there's still in utilities or healthcare, which are the traditional defensive sectors, those valuations are far more lower and attractive relative to tech. So we do think there's relative opportunity.
All right. Ben Ammons, who is the New Edge Wealth Senior Portfolio Manager and Head of Fixed Income. Thanks so much for taking the time here.
Thank you.
DJ.
And DJ and runner on the weekend. What a weekend warrior he is. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
Of course, we are marking 22 years since September 11th, 2001. We go now to a moment of silence at the New York Stock Exchange. That was a moment of silence there observed at the New York Stock Exchange to mark the anniversary of the attacks of September 11th, 2001. Traditionally, the New York Stock Exchange does mark the occasion in this way. Of course, the Stock Exchange, one of the places that was affected because of being downtown. Remember, it was shut for several days after the attacks, and because of the interconnected nature of the financial industry, many of the folks working on the floor knew people who worked in the towers, et cetera. And many of the folks who've worked down there since they've been on the floor for that long. So they mark this in this way, as we all mark that solemn anniversary today.
Absolutely. President Biden's going to be marking the ceremony at a military base in Anchorage, due there, and his visit even en route to Washington, D.C. From his international travels as well.
Right, visiting, making his G20 rounds to India, to Vietnam, and then stopping in Anchorage on his way back to the United States. All right, we want to now move on to our regular course of business and take a look at some movers that we are watching today. A big deal in the food industry today as shares of Hostess brands are surging after consumer goods company J.M. Smucker said it would acquire the Twinkies owner. Their transaction listing the deal at $5.6 billion. That does include debt, by the way. That's the total enterprise value of the transaction. And we're talking about $34.25 a share is what Hostess shareholders will receive for this deal. That is 54% higher than the closing price back on August 24th. That's the last trading day. After that, there were some reports that there could potentially be a transaction. And the Wall Street Journal had reported there were a lot of different suitors for Hostess, among them General Mills, but that Smucker beat out the cereal maker to buy the company. Yeah, it sounds like they're expecting this to close next year within the first 2 quarters of the year. So that's going to be interesting to see all of that come together with synergies, especially in production that they're going to be looking forward to as well here. I hope that they find some synergies for those bouncers that Hostess has, because my goodness, Smucker's needs to introduce some innovation on just keeping the bouncers together. They disintegrate way too quickly. Hopefully J.M. Smucker and Mark Smucker can answer that question for us. They can put some jam in there.
The,
peanut butter and jelly?
They got to do something.
Jelly bouncers? I don't know.
I mean, they should have come out with Uncrustables bouncers by now, but so maybe that's a brand that we can look forward to them putting some innovation around. I mean, Hostess has had a really interesting journey, if you will, right? Because the company has been through 2 bankruptcies, 2 Chapter 11 filings in the past. Andy Callahan, who has been took the company on in its
current iteration has really pushed through price increases, has taken advantage of this current wave of snack popularity among the U.S. population, but also has struggled with, as has every packaged food company right now, between that volume and price calculation that's been so tricky during this time of inflation. But both the companies have been seeing growing sales.
Yeah.
So Smucker has been making a lot of acquisitions, and this is the latest.
Yeah, $1.3 billion in sales in 2022 for Hostess. Well, also, we got to talk about Tesla shares this morning. Moving higher this morning after Morgan Stanley upgraded the company to hold from buy. The analyst Adam Jonas is bullish on Tesla's supercomputer Dojo, which is powered by artificial intelligence, and believes it puts the EV maker at an asymmetric advantage in a $10 trillion total addressable market. Jonas also raising his price target on the stock to $400 from $250 per share. So that one of the latest moves here around Tesla, and said specifically investors have been debating for a while whether it's an auto company or a tech company. He believes it's both and sees the biggest value driver being from software and services revenue for Tesla.
And this is a big note coming from Adam Jonas on this particular thesis here. He puts the total addressable market of whatever this is at $10 trillion. I guess the market for the supercomputer for artificial intelligence in general, and talks about adding up to $500 billion to that Tesla enterprise value. That's how he arrives then at the price target increase, which is sizable here. And this supercomputer that I guess Musk has talked about in the past, but this is the first time that Jonas and his team have really dug into it and tried to figure out what it could mean for the company. He likens it to what AWS did for Amazon as perhaps what Dojo can do for Tesla.
Well, Musk has said the same thing similarly before, saying that it makes sense to offer Dojo as a service. So perhaps kind of similar to what we've seen with AWS. There's also going to be a lot of data that's being able to be leveraged and going to be leveraged from Dojo. It's basically AI machine learning, and for video training, using the video data coming from its fleet of vehicles is how the company has described it in the past. And that amount of data, especially across the fleet of Tesla vehicles, that could be kind of integrated in anything from insurance processes all the way through just making the driving experience that much more safe, and perhaps push over-the-air updates as necessary once they get certain data points.
Yeah, and also Tesla is in focus this week because the new Elon Musk biography is coming out. Walter Isaacson's book. I spent part of the weekend reading the various reviews of the book, the various Q&As with Walter Isaacson as well. And one of the first news items to come out of the book was this idea that Musk had blocked Starlink access for the Ukrainian military, effectively preventing them from a sneak attack on the Russian submarine fleet at one point during the conflict between the two countries. Since then, there's been sort of some clarifications coming out. Maybe Musk made the change previously and didn't notify the Ukrainian military. It's whatever the case may be, Isaacson portrays him as being uncomfortable with the role that he now occupies in that conflict because of the way that the military has been using Starlink, which is kind of interesting. He also portrays him, not that this is a huge newsflash to anyone, as very mercurial. And in a Q&A I read, describes the sort of different modes, dark mode, demon mode, he describes it. Oh, wow. And then I think there was another one that was like idea mode or something more genius mode or whatever, where he's coming up and working with ideas. But definitely both a pivotal character in the development of electric vehicles in the U.S., but also a volatile one.
Yeah, well, a mercurial mind that you don't want to see in retrograde ever. Even as you think about all of the different pieces that Musk is moving around in across, whether it's SpaceX or Neuralink or Tesla, of course, or X, and whatever that will become, and the integration of all of these in one way or the other. Dare I say, Boring Company and their flamethrowers. It's really remarkable in many instances because it's eye-catching to people that all of this points back to one figure, but at the same time, it's a larger question of, okay, with that power, where will many of the ideas that have come forward be put forward to good use and good civic responsibility as well? And that's where I think it's become a little bit more murky.
Yes, indeed. And Isaacson also wrote about his acquisition of Twitter, which seems Like an interesting story. Well, there you have the opening bell on Wall Street. Let's do a quick check of the markets, sponsored by Tasty Trade as we get underway here this morning. And we should allow a few seconds, I suppose, to let the prices settle out here as we take a look at markets and a rebound in some key big tech players this morning, Tesla among them, as well as Apple shares coming back a little bit as we get underway here. So we've got the Dow trading higher out of the gate by about 170 points, 0.5%. The S&P rising by about 0.2%, and the Nasdaq in the pole position gaining about 0.9% here, just as the Nasdaq was leading to the downside last week, leading to the upside here today. Tesla definitely a part of that, Brad Smith, as we look at the bounce back that we're seeing in some of those big tech shares.
You know, every day I run with joy over to this Wi-Fi Interactive to try and figure out what view I'm going to give our viewers as we begin today's trading activity.
I would love the live cam of you running with joy over to the Wi-Fi Interactive.
It's like a prance. When in doubt, prance it out. Dow Jones Industrial Average right now, it opens up higher by about 0.5%. Year to date, you're seeing that up by about 4.8%. Nasdaq Composite, that opens up by about 0.9%. Year to date, solid move there that we're seeing on the tech-heavy average. That's up by about 32%. And the S&P 500 year to date, up by about 17%, holding on to some solid gains. And on the course of the early moments in today's trading session, as we're about 90 seconds in, you're seeing that up by about 0.7%. Since we mentioned the S&P 500, let's take a look at some of those sectors, why don't we? 11 of them. We've got them loaded up here for you on screen. Green across the board, so we won't dilly-dally here for too long, but take a look at XLY. That's up. Consumer discretionary, seeing gains of about 1.5% to start off the day. You've also got some materials action getting a bid here as XLV decided it didn't want to be part of the party anymore. Healthcare, down, flat, barely to the downside. Let's take another look at technology here. The Nasdaq 100. We've got that loaded up here for you on screen. You got some red spots, pimples, whatever you want to call them here on the day, but there's not too many of them. Bringing up the caboose here, you've got Moderna and AstraZeneca. They are down to start off the day and the week. However, we mentioned Tesla. We'll put this on kind of a larger view here and blow up some of those market caps for you here. Mega cap tech stocks, largely in the green here. Tesla, we mentioned them. They're up 5% right now, but taking a look at Apple, that's up by about 1%. Microsoft, Google, also seeing some good looks there. Whatever you call them, Alphabet, Google, in your home, your school, just call them up today.
Yep, seeing a lot of green on that screen. And let's get to another related story that is definitely affecting large cap tech. Qualcomm, those shares are higher this morning by about 3.5% after it struck a deal, really an extension of its deal with Apple. The semiconductor giant will supply Apple with its 5G chips until at least 2026. That deal indicating that Apple maybe isn't quite ready to rely on its own in-house chips just yet. Now, to be specific here, what Qualcomm makes for Apple is modem chips. That has something that Apple has said it wanted to explore making on its own. It bought a division from Intel to that effect, but this is a highly complex thing that it has to make. So there was some question over whether Qualcomm would continue to have this partnership. Now it's being extended through 2026. So good news for the chip maker.
Yeah, some interesting notes here as well from our executive editor who was able to touch base with the company, saying that on the financial front, it seems like that this new deal has a similar structure to the existing deal. No major changes there, but Apple's deal is not necessarily factored fully into the company's current guidance. Some of that guidance had included an outlook expecting 2 drivers of sequential revenue growth. They talked about this on the earnings call. QTL seasonality was one of those. Handset launched by a modem-only customer was the other one. And so that potentially where investors might be trying to read through the lines of what was talked about in the most recent earnings call and trying to put that together with what's been announced this morning.
Yeah, according to Bloomberg estimates, Qualcomm makes up almost a quarter of Qualcomm's revenue. So Apple, wait, did I say that about? Apple makes up about a quarter of Qualcomm's revenue. So a lot.
Yes.
They're very reliant on the company. No financial terms disclosed, but effectively this is just a relief for investors in Qualcomm that this is going to last a little longer. It was estimated that the partnership was going to end this year before this extension here. So, Qualcomm gets to ride it a little longer.
It's huge. Making sure that they've got a more solidified partnership with Apple, but then also at the same time making sure that they've got for a different part of their business and the Snapdragon 5G modem RF systems for smartphones from Samsung. Those deals run throughout 24, 25, and 2026 as well. So those two of the biggest smartphone manufacturers in the world, Qualcomm having both of them in their financials, one way or the other. Yeah. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
What is the thing that you most want to avoid in the market right now?
I would say market timing. There's a lot of dynamics about either being all in, all out, and look at what's happened year to date. I don't think anyone was anticipating the rally that we've seen in US equities. So this idea of just being balanced, staying invested, staying diversified, and not trying to time these markets.
Well, we've got a new face joining us this morning in the Yahoo Finance studio. That's our new anchor, Josh Lipton. Josh is a seasoned journalist and an expert on all things tech, semiconductors, cloud computing, video games, you name it. We couldn't be more excited to have him join the team. Welcome, Josh.
I'm so honored to be with you guys. Honestly, fast, hard-charging group of business reporters. So humbled to join the team.
Look, we're prancing deep into coverage here every day, and we're excited to have you on now with us.
Thank you.
We know that you've been covering tech for years. What are you looking for at Apple's event this week, this showcase tomorrow?
Yeah, so this is, listen, if you're an Apple fan, you're an Apple investor, this is one of those dates you've got marked on your calendar. This is a marquee event. And what you expect, of course, is Tim Cook is going to take the stage and he's going to introduce new iPhones. And really, he's got a big job because he has to introduce those iPhones, but he also has to really just get consumers all over the world excited about it, because a win for Apple here obviously is kickstarting really a meaningful upgrade cycle, re-accelerating growth. But it's interesting because I checked in with Gene Munster. There's a name you both know, right? Gene's been covering Apple for some 20 years. Knows the company backwards and forwards. And it was interesting because Munster is still very bulled up on Apple, right? Still a believer. He does think there's going to be a meaningful upgrade cycle. But when I was talking to him, he did point out some challenges, some potential challenges. And one was a cost-conscious consumer, obviously, right? End of the day, Apple is a consumer-facing company. And we know, we just got through this last earnings season. We heard the CEOs and CFOs, and when they were talking about Apple, talking about consumers, it was often cautious for all the reasons we talk about on Yahoo Finance with rising energy prices, hiring borrowing costs. So that could be a challenge, selling new devices against that backdrop. And also China. Munster brought up China. China, of course, is so critical for Apple. It's a key link in that company's supply chain, also a key end market for Apple. But we know, as we've been covering, we got these reports, a ban on using iPhones by central government officials in China. So, it was just so interesting because with Apple, there was always this narrative, this story that they had kind of a unique place in China because they sell popular products and millions of Chinese go to work every day assembling those products. So the idea always was, well, the Chinese government, the CCP, would only clamp down on Apple so much. They don't want to shoot themselves in the foot. I do think maybe you wonder, given these recent headlines, is that assumption, is that thesis being tested a bit?
And the Apple shares, interestingly, are not up as much as they were earlier. They're pretty much erasing their gain, so we'll keep watching those. Josh, this is a fun moment for me because you and I used to work together at Bloomberg in a prior life, so a little reunion here for us at Yahoo Finance. What else do you want people to know about you here as you come to Yahoo Finance? You've been in this business for a long time. Like, what do you want viewers to know?
Wow. So the bio about Josh Lipton is what you... Listen, I've been a reporter, Julie, for 20 years, and we worked together at another network, started off in markets and then switched to tech. For me, covering the markets was something I did as a print reporter, then on air, and tech has also been something I've always been excited about. The immediacy of it, it's complex, it's intellectually challenging. So I'm excited because at Yahoo Finance, you get to talk about so much. It's business, it's economics, it's financial markets, we do it all. And that's part of the reason I was so excited really to join the team.
What do you think is the biggest story that is not getting enough attention in tech this year? Because we've all been hyper-focused around AI, and now there's going to be even more focus this week around handsets, new smartphones. Yeah. But is there something out there that viewers might be missing out on right now?
I don't know if it's missing out. I mean, to bring it back to Apple, I would expect all the conversation to be about iPhone and watch and AirPods. I think that'll be the focus, right? If there may be Mac and iPad news. That's usually something they save for a later date or even just a press release. I'm still excited about headsets, honestly. I don't know if we're going to hear about that at this conference. I would actually be kind of surprised if they have an update. I bet it comes later in the year. But if you're asking me for a tech, I think that's still really fascinating. And I don't sleep on Apple's headset. I mean, I think right now people think, hey, when they do launch that, it's going to be this kind of low volume, high margin product. And that makes sense to me. But I look ahead, I'm really excited for that launch because I look ahead about what Apple could be thinking there, how you could marry that technology with some of their other interests. I think of Eddie Q, the head of services at Apple, big sports guy, right? And how they may marry that tech with live sports rights. I think that could get real exciting, especially if they're also going to maybe lower the price point a bit.
And you've talked to Tim Cook through the years. What has that been like talking to him, and what's his vibe around events like this?
I have gotten to know Tim Cook. I used to speak to Tim and then also the CFO, Luca Maestri, every quarter. That was always a highlight. It was a highlight because, one, they genuinely, I think, enjoy talking to reporters. You know, I think
Which is not the case everywhere.
That is not the case. As you both well know, sometimes you talk to an executive, it couldn't be more clear. They really don't want to be there. They don't enjoy the process. That's just not true with those two. I think they really do. They like making Apple's case. They actually even like debating the points. And so that was always just fun as a reporter. You had to bring your A game. You better have your I's dotted and your T's crossed. They want the questions to be sharp and hopefully smart. But that was also, you know, always one big highlight of every quarter.
Well, we're looking forward to much more coverage as well here. Thanks so much for joining the team.
Hey, thank you guys. Thank you for having me.
Absolutely. Well, we've got much more from Josh Lipton, and we've got much more right now, as investors and consumers alike are eagerly awaiting and anticipating Apple's keynote event tomorrow, dubbed Wonderlust. The company is expected to unveil several new products, but the star of the show, the crown jewel, if you will, likely the new iPhone 15. There are rumors of a higher price point and a new charging port. All will be revealed tomorrow, 1 p.m. Eastern Time. With us now to discuss, we've got Philip Shoemaker, who is the founding director of the Apple App Store and Identity.com executive director. Thanks so much for joining us here this morning. So first and foremost, kind of broad strokes here, what are you expecting? What is going to be the highlight of this?
Well, the big highlight has to be the new phones, right? I mean, that's the main thing that Apple's going to be focusing on is the iPhone 15. And they're going to be driving home a higher price point, all right, for the most part, because they want to be able to help bring these premium devices to market as soon as possible.
And when you look at the sort of waves and the upgrade cycle, if you will, Phil, what do you think is most motivating the company in its thinking about where to focus its attention on updating the phone, and where do you think consumers are focusing on what they want?
Yeah, I think one of the big issues that Apple has been having these past few years is that people aren't upgrading devices like they used to. If you remember back in 2010, 2011, everybody got the next new phone. Each year drove a hefty upgrade cycle. And we're not seeing that anymore. People are relying more heavily on the services, Apple included. So I think what people want is new functionality, right? Where is the Steve, here's one more thing moment, right, in each of these presentations? Because we want something more than just new cameras on the phone, maybe new biometrics, et cetera. So we want something bigger and better than that. That's what consumers are expecting. But Apple really wants to be able to help drive more services and a more upgrade volume. So they're trying to figure out what that next thing is. And right now it's been cameras. And I think that's what we're going to see with the iPhone 15 Pro and the Pro Max is that we're going to see brand new cameras with really good quality.
What does Apple need to say or do to show investors as well that it's really committed to furthering the deepening of its ecosystem through many of these products?
Well, I think something that Apple really needs to do is be able to expand that ecosystem by opening up new avenues for the App Store, right? Let's extend the App Store. Let's add new types of functionality, new types of apps that are allowed and approved into the store. But Apple's been reticent to do that for quite some time. So I think we're going to see a loosening of the guidelines over time. So new types of apps hit the store, because as we've always seen, a variety of apps and new types of apps help drive more upgrades and more volume on purchasing of iPhones. So that's one of the key things. You know, I think one of the other interesting things we're going to see is new hardware, because the USB-C should be hitting the market with these iPhone 15s rather than the Lightning adapter. We're going to see USB-C, which will help drive that connector market as well.
I want to go back to the point you were making about the App Store, because part of that opening up, of course, seems to be under legal pressure in various jurisdictions, right, where there's been some scrutiny of the closed system that is the App Store. It has worked for Apple, right, for many years. This, not just with the App Store, but its overall sort of closed system. You happen to be operating in a more open world now, right? In your current gig, you're at a permissionless conference right now, I believe.
Right.
Do you think Apple, how much do you think it can continue in that mode of being more of a closed system? And again, it has worked for them.
Yeah, part of the reason it's worked so well is that if Apple controls all the apps that go onto the phone, they can control the number of times your phone crashes or anything that helps bring it down. Because look, a rogue app can do damage to your phone. Maybe not long-term damage, but short-term damage, which will make the users less interested in buying a new app or buying a new phone. It'll help drive them away from this ecosystem. So Apple has done a great job of keeping this ecosystem closed in a way that makes it very compelling for a user. But one of the problems is that they're missing out whole areas of the marketplace as well. Android is starting to open up to different things like cryptocurrency apps and Web3 related apps, as well as other technologies. And Apple will do that over time, because I think having to carry that burden of being the only company that controls everything that goes onto the device is burdensome. And over time, they are going to relinquish control, but in a way that does it by keeping the phone solid and making sure that users aren't being defrauded and that users' devices aren't crashing.
What is the sweet spot for pricing on this new iPhone that Apple has to strike and get correct?
Look, I think we're all at a point right now where the numbers need to be lower than they are. To me, ideally, it needs to be sub 1,000 for these devices, but we're absolutely not going to see that. I think we're going to see around $1,299 and higher for new devices, especially with the pros. They might go upwards of $1,500 a device, which is a little problem in this market right now.
All right, Philip Shoemaker, founding director of the Apple App Store and Identity.com executive director. Thanks so much for your perspective. I appreciate it.
Thank you.
Got much more markets action coming up. Stay tuned. You're watching Yahoo Finance. Are we going to continue to see a slump in stocks from here?
I think we're going to continue to see some volatility. There's a lot of catalysts that are on the horizon, from the CPI print, the trajectory of the Fed, looking at earnings and the health of the consumer. So while it may not be a slump, I think we'll see some choppy markets from here to the end of the year.
Is the dollar still king? Yes, probably. But it seems like some central banks might be pushing back on the recent strength that we've seen. Yahoo Finance's Jared Blickery has the details of our biased opinion, perhaps, if the dollar is still king. Biased to a certain extent, though. There's data. Jared's got that. Hey, Jared.
Hey, thank you. Let's still go to the Wi-Fi Interactive after that glorious introduction there. I'm going to focus on what the PBOC, the Chinese central bank, is pushing back against, and that would be a stronger U.S. dollar. Now, the Chinese government manages their currency in two different phases. One is the onshore yuan, and that is what we are looking at here. That is CNY equals X in the Yahoo Finance ticker system. You can see that's at $7.2925 dollars per Chinese yuan, yuan per Chinese dollar. Now you take a look at what's happening on the offshore market. That's kind of the free floating currency. That's a little bit higher here. Now a higher number means a stronger dollar and a weaker currency. So the Chinese government with their onshore yuan is trying to make that artificially stronger than the market. Problem is, this has not been working. Here is a year-to-date chart of what has happened, and you can see the US dollar has advanced 5.74%, going in the wrong direction. Now, a weaker currency for the Chinese government does solve some of their problems, but it also introduces others. One of the big problems with a weakening currency, which helps exports, is that it leads to capital outflows. That is, people over there holding yuan in all over the world, they want to exchange those and hold something that is not losing value. So that's what the Chinese government is pushing back against, and a lot of their measures have just been half measures so far. The market has taken it in stride and not really taken it seriously, because we've seen opposite reactions in the market with which we would expect them to go if they did respect what the government is doing here. Now, I also want to show you what's going on in the US dollar. Broadly speaking, this is a year-to-date chart. The US dollar is down today. If I show you a candlestick chart, you can see on a 3-month basis, it is ticking down, but this is in a definite uptrend. This is in the midst of a 3-month or 2-month uptrend here. And if we look at the broad currency pairs here of the US dollar, you can see all that red means the US dollar is weakening against all but two of the currencies. Those two in green are the Turkish lira and the Argentine peso. So really a lot of weakness here. Now, what's really impressive when we talk about dollar strength and dollar weakness is the effect that it has on the futures market. So let's take a look at what's happened in futures. We're seeing copper, that is picking up. That is taking advantage of a weaker US dollar today. But you take a look at what's happened over the last couple months with copper, it has gone sideways. Meanwhile, the US dollar has been trending up. So what does that tell me? If the US dollar were to reverse course, that would aid a nice rally in copper futures, which have so far been depressed. You can see there's that big lead up earlier in the year. That was China reopening optimism, but that largely faded. So one of the things I'm looking forward to in CPI this week is to see exactly how much commodity inflation is picking up. And we're going to see that in energy prices. Headline CPI expected to print a 3.6, and that is up from a 3.0 only 2 months ago. So if we see a rise in goods inflation and a declining dollar, you can see the virtuous or unvirtuous cycle that creates.
And we'll keep watching that. Thanks so much, Jared Blickery, talking us through the latest dollar action and the ripple effect. Next, Yahoo Finance is laser focused on the trends in tech you need to know about. This morning, we're looking at AI and its impact on the jobs market. For many, artificial intelligence is the biggest threat to America's working class in a century. For others, it's the job creator we've been waiting for.
But what jobs? Professional, managerial, technical? We look at some of the nuances that others might be missing. We'll speak with two authorities on the matter. We've got Neil Parikh, who is the New York City first director of AI, and Robert Simmons was on President Obama's Council of Economic Advisors. We've got all that ahead on Next. Don't miss it. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
Any back-to-school tips or things that you try to utilize? Well, first of all, I don't know if you have kids.
I have two boys. Two boys. They started this week.
All right. And so, how do you get ready?
I try to make sure they have their supplies, they have their agendas. We already lost a water bottle, so I am
already.
I know. I'm getting a solid C+ on back to school.
Yeah, I try to stress not too much about the whole thing.
It is just after 10 a.m. in New York City. This is Yahoo Finance Live. I'm Brad Smith alongside Julie Hyman. We're about 30 minutes into the trading day. Let's take a look at how stocks are moving now. First and foremost, stocks, well, they're gaining some traction as investors await a big week for data. Consumer and producer prices across they're crossing this Thursday and Wednesday and Thursday respectively, giving the latest insight into inflation ahead of next week's Fed meeting. Plus, in the world of big tech, Apple's annual fall product launch event is set to make headlines tomorrow.
And also in technology and looking at some individual names, Alibaba is on the move today. The share's down about 1% after its outgoing CEO, Daniel Zhang, unexpectedly stepped down from his new position running the company's cloud division. Zhang was due to exit as the Chinese e-commerce giant CEO and chairman. He was going to focus on the cloud business, which is reportedly expected to spin off, but now an unexpected exit.
We're also watching Boeing shares get a little boost after President Biden, in a speech in Vietnam over the weekend, said he welcomed an $8 billion deal between Boeing and Vietnam Air for 737 MAX jets. The airline put in an order for 50 MAX jets with the possibility for more down the line.
And we have our eyes on Canopy Growth, the cannabis company trading above $1 for the first time since May, up another 23% today. The stock has been very volatile in recent days, surging quite a bit on hopes for legislation following the U.S. Department of Health and Human Services recommendation to reclassify marijuana to a Schedule III drug, as well as a Politico report that pointed to the possibility that the Senate's Safe Banking Act could finally, in the view of the industry, see the light of day.
Artificial intelligence gained popularity in late 2022 thanks to OpenAI's ChatGPT. Tech giants like Microsoft, Nvidia, Google, they've all leaned into the AI buzz, investing billions in developing machine learning technology and projecting billions in revenue over the next few years. But not everyone is hyped about the future of AI. While some managers see it as a possible tool to boost productivity, workers see the potential to lose their jobs to the new technology. A survey done by the American Psychological Association found that 38% of people worry that AI could make their job obsolete. Joining us now for the latest in Yahoo Finance's next series are Neil Parikh, the former director of AI for New York City, and Robert Simmons, who is the new NYU Stern School of Business Professor of Management and Organizations. Great to have you both here with us this morning, particularly as we think about what this means for the future of work and productivity. Neil, I would love to know how, even from an administration perspective or even from government level perspectives too, this is being thought about and this is being deployed as a productive asset, but at the same time recognizing what it means for the future of employment.
Sure. And thanks for having me. First of all, I should say that I worked for the city under the de Blasio administration, so I really can't speak for, each administration has their own take on these things, and it's changed now. At that time, really the focus was, in some cases, increasing the capacity of the city government, city agencies, as well as the mayor's office to think about these things in a structured way. So we focused a lot on educating folks about what AI can and can't do, where it is and isn't appropriate, and things like that. A lot of the sort of very high profile applications of AI tend to get outsized attention. So, facial recognition is a very controversial use case. But actually, the city government uses AI and has to think about AI in many different aspects. So it's concerned with economic development. It's concerned with CUNY programs, reskilling programs, talent pipelines, all kinds of things, as well as policy and governance. In terms of where the city actually uses these things, that can also take a diverse range of roles. So for instance, New York City Cyber Command is the city's cyber defense agency. That's a large infrastructure kind of application of AI that a person couldn't do and doesn't really impact residents in any direct way. There are other kinds of things that are back office administrative applications that don't cause job loss and just make the city more efficient and make the city save money. Then there's a set of things that do affect residents in a direct way, things like applications in the criminal justice system and so on, and those things require significantly more care and oversight. But I would just say people should keep in mind that there's a very wide range of applications, and it's not either just in the most high-profile areas, and they also don't often use technologies like ChatGPT or what you read about in the news. These are often methods from 100 years ago.
Right. I mean, so that brings up an important point, I think, between the sort of perception and reality gap when it comes to these conversations around AI. And interestingly, you wrote a paper back in March that tried to quantify in a little bit more of a systematic way, I should say, what jobs might actually be affected. And you were looking specifically at large language models, right? That aspect of
correct.
AI. So what did you find the jobs that might be directly affected?
Yeah, so the first of all, thank you for asking about the paper that we wrote, and thanks for having me on the show. I appreciate it. So we very intentionally used the term exposed. So what we tried to do in that paper was identify the jobs that are most exposed to advances in language modeling. So lots of exposure may or may not lead to a job being affected, may or may not lead to a job being substituted away by the technology. My take is that actually most of these jobs are not going to be substituted away by the technology, but will be instead augmented by the technology. In terms of the occupations, so one of the surprises is that of the top 20 occupations most exposed to advances in language modeling, 17 of those 20 are college professors.
I
different types of college
have to
professors.
say, I
So
was
that's
really
me.
surprised by that. Why exactly is that?
Yeah, so it's because in our job we use language a lot. So we spend a lot of time preparing lectures, we spend a lot of time delivering lectures, we spend a lot of time assessing work from students, and so things like large language models can assist with that preparation and with that assessment.
And so you mentioned something very key here, and I think we've looked at productivity and said, okay, so the quantity of work might have a delta to kind of a better end here. If you look at the amount of time that people are spending on certain tasks and saying, okay, you can either get through tasks that much more easily, or there are certain tasks that are just going to get taken off your plate. But on the qualitative side as well, how do we look at the quality of jobs being augmented by AI in the future too?
Right. So again, I think most jobs will probably be augmented by AI. Perhaps some jobs will be substituted away, but I think those are pretty few and far between, those types of jobs. In terms of the different ways in which jobs will be augmented, I think it really depends a lot on the specifics of the job. So I could give you, many different examples of ways that I use ChatGPT, for example, which is an example of a large language model in my own work, and that's things like helping to prepare the lectures that I'm going to deliver, helping to create the PowerPoint slides that I'm going to use, and things like that. A very different occupation, but one that also is highly exposed to advances in large language modeling, is actually judges. And when you think about what judges do, they also spend a lot of time preparing text, sort of parsing through text, preparing, written text and things like that. So a very different end goal when it comes to what a judge does relative to what a professor does. But nevertheless, you can see that there are going to be similar types of ways in which the new technology will augment the work in these different occupations.
So whether we're talking about augmentation, if indeed that's going to be the case in most situations, or we're talking about elimination maybe in a smaller degree of cases, I'm curious, Neil, about the role that government should play in whether we're talking about reskilling or, somehow helping the populace cope with some of these big changes.
Yeah, I mean, actually, I think it's important not to forget a third category, which is people who work for an AI. So a lot of gig workers essentially don't work for a person, they work for an AI. So if you think about Uber and Lyft drivers, the dispatching system is an AI that sends them around, sets the pricing, and things like that. So that's a very different interaction with AI than people who use it as an assistive technology or people who may be sort of replaced altogether. So that's an important case. That's actually a case where I think some of these questions are the clearest in terms of what the government should do and study and both sort of educate the workers and also gather a lot more data on what kinds of things are actually helping versus there have been some studies on what it's like to work for one of these systems, and a lot of it leaves much to be desired. And that's a case where the government certainly can step in, both gather more data and help work towards best practices and ultimately codify those kinds of things in worker protection regulations.
I never framed it that way, that if you're an Uber or Lyft driver, you're effectively working for an AI, but I guess you are.
Well, to that end as well, and in both of your studies, it would be interesting and what you've implemented as well, it would be interesting to know or hear about how this changes the compensation calculus at the end of the day too. For a lot of workers that in their field have become accustomed to earning a certain amount in their wages or in salary, whatever that looks like in that package. Does AI drastically change that equation?
I mean, it can change some of those things, both in terms of what it's like to work for one of these things, which can be very unforgiving. So in the case of an Uber or Lyft driver, you have a certain amount of control, and there are learned behaviors like the driver will periodically shut off and turn back on the system that does certain things in the dispatching algorithm that they prefer. But if you're working in an Amazon warehouse, you're also kind of working for an AI system. And I'm sure people are familiar with some of the reporting that's come out of there where that can be really, really difficult. I mean, people, it won't let people take bathroom breaks and things like that. That's not something I would necessarily blame on AI because it's coming from, it's a byproduct of the people who designed the system. I mean, but nevertheless, that's a very difficult place to be in. And certainly there's, I mean, in the news right now, there's the Hollywood writers' strike. A large part of that strike is about compensation structures and how they relate to AI. That is the studio allowed to just reproduce scripts of the type that you've been writing for Law and Order or some sitcom or whatever it might be. Or in the case of extras, they want to be able to image people and use their likeness in a movie without having to pay them going forward. So there are absolutely a range of impacts that it can have, both in quality of work and in compensation.
It's interesting because a lot of the jobs you're talking about are not traditional white-collar jobs, right? They're more blue-collar or less skilled worker jobs, whereas the jobs that you examine that are more affected by large language models are, in fact, more traditionally professional industries. So that makes me wonder then if the regulation that could eventually come will be more focused on folks who traditionally have more power, if you will, in the worker structure, these professional folks, leaving some of these other people more vulnerable, or maybe I'm making too much of a leap, I don't know.
Well, I think one thing I want to bring into this, we've been talking about a variety of different types of occupations. I think one thing that's important to realize is that even focusing in on a specific occupation, there's a lot of heterogeneity within that occupation. One of the sources of heterogeneity would be the amount of experience that a given worker has. And so on the, we were talking about augmentation, AI augmenting the work that people do. Some of the recent work, really well done work in economics that has come out, shows that it's actually the less experienced workers that benefit more from the use of things like ChatGPT and other types of generative AI. You can see their productivity grow much faster than the more experienced workers. And so, again, I think that sort of points to, we'd want to be careful with policy, that we wouldn't want a policy that hinders the adoption and use of this, because if anything, it looks like it's less experienced workers that would benefit the most.
But then I wonder, do you get a devaluation of the more experienced workers in turn? Sorry, go ahead.
No, I was just going to say that I would also caution lumping things together, not just at the occupation level, but sort of a white-collar, blue-collar divide, because it often doesn't break down like that. The thing with white-collar work is that the things that you're working with are already digitized, so that's a lot easier for a computer to work with, whereas someone like a construction worker, this is incredibly difficult to automate. Way, way, way harder than things like paralegal work or low-level accounting or things like that, where you're manipulating things that are kind of already on a computer.
Yeah, that's a good point. Guys, thank you so much. I could go on for much longer on this, but we got to leave it there for now. Neil Parekh is the former director of AI for New York City, and Robert Siemens, NYU Stern School of Business professor of management and organizations. Thanks to you both. Really appreciate it.
Thank you.
We got much more coming up. Stay tuned. You're watching Yahoo Finance. Are your clients paying attention to politics yet, particularly presidential politics?
Starting. It is starting. So the questions have been coming in, I would say really over the past couple of weeks, and really just trying to anticipate what does this mean from an investment standpoint. And our view is trading around politics is a very dangerous game. So don't let politics drive your portfolio. Let the markets and the economy drive it.
Let's do a quick check of the market, sponsored by Tasty Trade here. We are looking at stocks that are in the green, although not as much as they were out of the gate here this morning. The Dow, the S&P, and the Nasdaq all trading higher in the neighborhood of 0.3% to 0.4% here on this Monday morning. We've been talking about the sort of comeback we've been seeing in technology. Shares of Apple, by the way, are now lower. We've been talking about awaiting the phone release, but also the blowback from last week's reports that there had been some banning of iPhones in China. So that had equaled a rebound early today, but it has faded. Well, from Apple news to auto worker contract disputes, this is a big week. To show us what's coming down the pipe, Yahoo finance reporter Josh Schaefer, as always, is setting us up for the week. So what do we got?
Julie. So it's not an overly crowded calendar that I'm standing with today like we have sometimes in earnings season, but it is a pretty big calendar and some potential market-moving events almost every day of the week, starting with that Apple event on Tuesday. So we're expecting Apple to announce the iPhone 15 tomorrow and give further details on maybe some other products. There were rumors maybe there'd be new AirPods. They're also going to talk about that new USB-C charger that's going to come with that iPhone. But again, we've been watching Apple shares relatively under pressure over the last week. We know Apple is a big part of the major indexes. It's in a lot of those ETFs out there. So just a big driver for market action in general for what we see from that event tomorrow. On Wednesday, we're going to shift more to the economic data side with CPI and take a look at inflation and see where inflation is headed. I'm going to dig into that number a little bit more in a second. I want to get to Thursday first. Is that deadline for the Union of Auto Workers with Ford, GM, and Stellantis? Multiple Wall Street analysts out with research today and notes saying they think that this is probably going to result in a strike now starting on Thursday. So keep an eye out on those stocks, Ford, GM, and Stellantis again. Now I want to zoom in on inflation though, because that's the big one, at least for me this week, I think, ahead of that Fed meeting next week. And what we're expecting, so what we're looking at here is CPI and then core CPI. So that excludes food and energy. Core CPI coming in at 4.7% last month. That's expected to come down to about 4.1% on Wednesday's report. But what's expected to go up, interestingly, is this purple line here, which is headline CPI. That is not fully what the Fed is watching, but it's what a lot of Americans are watching, because it's expected to go up from 3.2% in August to 3.6%. Largely driven by gas prices. So it's going to be interesting to see how people sort of digest this CPI report on Wednesday, because we're likely to again see that headline number come up, but the core number come down. So you could say maybe a good thing for the Fed, but at some point you have to think Americans are starting to feel this a little bit if gas and food are still expensive, guys. That still counts when we think about how inflation is impacting the American consumer.
Yes, and it affects perception, most definitely.
Do we have your excitement meter graphic yet?
Brad, no, we don't, but I put it pretty high. I put it pretty high this week.
Out of 10, where are we? So it's like an 8.5, 9?
Oh, I'd say it's like an 8.5. There's a good chance for some good moves this week in an inflation print.
We didn't even talk about football.
And we didn't even talk about football.
We didn't need to.
An 8.5 without even football. Wow.
Well, you know what? The Eagles won. There it is. That's everything you need to know.
So Brad's excitement meter
and Brad knows I'm a
10
Patriots
right
fan.
now.
Bingo. There you go. Wow. Had those Pats too. Josh Schaefer, local Patriots fan, joining us here in studio. Thanks so much. Appreciate it. Well, the G20 wrapped this weekend in India. There were leaders of 20 countries and unions. Notably, two big nations were not represented. That was President Xi Jinping of China and President Putin of Russia, absent from the summit. The G20 joint statement on the war in Ukraine is making headlines today for not criticizing Russia on its invasion of Ukraine. To talk about the impact of the meeting, we've got Greg Valliere, who is the AGF Investments Chief U.S. Policy Strategist. Plus, we've got Steve Clemens, Semaphore Editor at Large. Great to have you both here with us today. Steve, I'll start with you. Kind of broad brush looking at what came from this meeting in the absence of two notable countries. What is kind of the larger thinking around what this sets up for international relations ahead of a 2024 general election year here in the U.S.?
Well, look, I think the big story that comes out of this is that Modi ran a great G20 meeting. This is what they call the rise of the rest, not the rise of the West. This was India asserting the fact that it's got a plan. It launched a major global biofuels initiative. And even with China and Russia not there, the distinctiveness of Modi's control and direction in this is a big story, I think. I mean, usually these kinds of gatherings are dominated by essentially Europe and the United States with, other G20 members, to broaden it, but this is really the developing. And he brought in the African Union as a permanent member of the G20, and the handoff in the presidency of the G20 is to Brazil next year. So this sort of theme and current will continue, and I think it's a distinctive moment in the G20's history.
Greg, what do you think here in terms of not just the G20, but also President Biden's performance there? Although, as Steve points out, the focus is really on the host, right, and some of the other participants. But what do you think there of Biden's not just performance in India, but also he made a sidetrack to Vietnam?
Yeah, the Vietnam trip I think went well, but the G20 outcome I think was really pretty limp, pretty lame. They didn't really say anything strong about Russia and Ukraine. I think a lot of countries are incredulous that the U.S. didn't say anything or get anything passed that was more assertive. So I'd have to say that this, in addition to having two leading players not there, they didn't do what they should have done, in my opinion, on Ukraine. So I give this a C- or a D.
What's also sort of striking to me as you look at this gathering of world leaders, Modi is 72, right? The Prime Minister of Vietnam, who Biden met with, is also up there. Biden himself, we talk a lot about the gerontocracy here at home, but I guess it's also true on the world stage. Although it doesn't seem to be an issue as much for Modi, Steve, in India, as perhaps it is here for Biden.
I mean, Modi seems vibrant, in control. I mean, I think that he's just, he's demonstrating a nimbleness and vibrancy with what he wants to do. And with all due respect to President Biden, that was not what he conveyed. I agree with Greg entirely, with Russia and China not on the playing stage, we got a very watered down resolution opposing the use of force and invasion to expand territorial expansion. And, somehow the Russians were fine with that because Russia was not mentioned in it, but it showed a kind of failure there. And I think that even when he went to Vietnam, maybe that trip went okay, but essentially he's saying, hey, we're not trying to contain China, the message from the United States in all of this is lukewarm at best and not defined by a plan or strategy. I think the most that you could say kind of came out maybe a little bit pro-American is that there was a big rail and ports initiative between the Middle East and South Asia that they say was not the China, Belt and Road Initiative. So maybe that's good for the West. But it was very lukewarm for the West and very bullish for the rising, what you would call global South and the great big developing nations out there. And I think it was a big net plus for Africa, where right now, which is going through a lot of tumult, but again, the United States is not seen as a big player in the African scene right now.
Greg, just very quickly, it sounded like you were about to chime in on the same question there.
No, you mentioned the age of some leaders. Biden, who got tired, I'd get tired if I had a schedule like that he had in the last few days. And he had a press conference, and then he said, I got to go to bed now. I have a hunch that soundbite will be used in the presidential campaign next year. You don't say, I'm tired, I got to go to bed now. I think that doesn't help somebody who's about to turn 81 years old later this fall.
Yeah, I guess it's not an actions speak louder than words situation, because before he said, I got to go to bed, to your point, he was running around all over the place. But when you have that soundbite, maybe it doesn't do you any favors. Let's talk more about domestic politics for a moment. The Senate back in session tomorrow, which has about 3 weeks to pass spending legislation before September 30th. Or if we're talking about it again, the government shutdown. Greg, I'll go to you first on this. Do you think there will be a resolution before the deadline?
Probably not. I think there are enough hardliners in the House who want to defy Kevin McCarthy. I think their demands are totally unrealistic. And I think there's a decent chance there will be a shutdown. I don't think it's a huge negative for the economy if there's a shutdown. I mean, if you want to go to a national park, maybe you can't. But, the Fitch rating agency this summer talked about how dysfunctional our budget process is, and they'll get more ammunition for that argument probably at the end of this month.
Yeah, and you sensed it in Julie's voice earlier as well. I mean, and all of us wanting to hit the I'm tired, I got to go to bed now on this discussion every time it comes up. Steve, is there likely to ever be any type of budgeting reform so that we don't always get to this impasse?
Well, budgeting reform would mean that legislators who are right at the edge of power, the Marjorie Taylor Greens and the Chip Roys and others who can, the Matt Gaetzes who can hold the Speaker of the House essentially hostage to, whatever positioning they've got. When you have a narrow majority, you're not going to reform anything because someone in that equation has a lot of power. So my answer is unequivocally no. I agree with Greg's assessment, but the other, fly in the ointment here is that before you get to this, some of those holdouts and those hardliners are demanding, an impeachment inquiry into President Biden. And so I think Kevin McCarthy is going to have an interesting month.
Yeah, most definitely. We also got the news, by the way, that Nancy Pelosi is going to be running again, which was a bit of a surprise. And to take a step back here, I mean, you look at that sort of entrenched leadership, you could argue, on the Democratic side. You look at this, perpetual argument over government shutdowns. We talk about the approval rating of the president, but the approval rating of Congress is problematic as well. Greg, does it matter to members of Congress if sort of writ large their approval rating's bad as long as they keep getting voted in?
No, I don't think it matters a lot, but I do think that the hardliners are the ones to watch, the Marjorie Taylor Greens. As Steve was saying, there are people who are going to be quite militant on this. I'd like to think that this can get resolved, but I think this drags on one way or another, either through kick the can or a temporary continuing resolution. This thing's going to drag on until the middle of December.
Oh, Greg, come on. Give me some better news here. Oh, we love talking about this
realist.
stuff. Yeah, true. Give it to me straight. Greg Valliere, AGF Investments Chief U.S. Policy Strategist, and Steve Clemens, Semaphore Editor-at-Large. Thanks, guys. Appreciate it.
Thank you.
We got much more markets action coming up. You're watching Yahoo Finance. What is your best idea right now in terms of either asset class or sector that you think is going to outperform?
We like diversified fixed income at these levels. We've been extending duration in our portfolios over the past couple of weeks and really taking advantage of both yields on the short end of the curve, the attractive T-bills, as well as trying to lock in some of these high rates because we do think that the Fed is closer to the end of their hiking trajectory.
This week, ARM is expected to go public. Its IPO and Instacart's expected later this month as well. Yahoo Finance's executive editor Brian Sozzi sat down with Goldman Sachs CEO David Solomon to talk about some of the much anticipated IPOs coming this month.
I think you know that the firm for over 15 years has been incredibly committed to our 10,000 small business program. We've brought the program to over 14,000 small businesses across the country. And the history of the program and the way we rolled the program out over the last 15 years is we went into cities around the country to really increase business education for small businesses. And as we're looking to expand further, one of the things we think is desperately needed is help for businesses in rural parts of the country where they don't have the same access to resources that they might have in some of the cities. And so back in 2021, Senator Kramer invited me out to North Dakota, and we had a good meeting out here where we spent some time talking about small businesses here. We were thinking a lot about what we could do more broadly to expand our 10,000 small business program, and we really saw that there was a real need. You know, when you look broadly across the country and you look at a state like North Dakota and also Arkansas, which is the second state we're rolling this additional program out to that we announced today, 99% of all the businesses in these states are small businesses. You know, it's pretty consistent across the country that small businesses drive a lot of the jobs in the United States. 42% of all employment in the United States comes from companies that employ less than 50 people. And so as we wanted to expand 10,000 small businesses, we thought we should develop a program that could really support it in rural communities. We decided to start with North Dakota and Arkansas, but we certainly have plans to roll it out to other states shortly, including South Dakota and other states in the Midwest that we're targeting. We've done a bunch of research. We've had about 75 meetings to look at where we think there's need. And we're excited that this $100 million commitment today, which $75 million goes to fund CDFIs, $15 million to fund the community colleges that support the educational effort, and $10 million to make capital more accessible. We think this is a good start to expand the program rurally, and that $75 million of grants to CDFIs brings our total commitment to CDFIs through this program up to $1.6 billion. So we think this can continue to have a broader impact on small businesses across the country. That generates, obviously, economic growth, and we think it's very important for the economic ecosystem of the United States.
I talked to your chief economist, Jan Hatzius, at the tech conference. Now, he lowered this week his recession odds from, believe it was from 20% to 15%, so a little bit better there. But when you talk to small businesses, are they still worried about a recession? And how, what's the economic vibe from that small business customer?
Sure. So Jan did lower his economic prediction for recession. There's no question the U.S. economy has been a lot more resilient over the last 12 months than we would have expected. I think the chance for a softer landing right now is much higher than we would have anticipated a year ago. That said, small businesses feel the brunt of inflation, higher interest rates much more directly than large organizations. They don't have the flexibility or the nimbleness or the resources to necessarily brave those headwinds so quickly. I think we all know that the pandemic was devastating to small businesses across the United States. A lot of them are service businesses that definitely lost their ability to serve customers during the pandemic. They had to save more aggressively to keep their businesses growing. And so small businesses have definitely had a bumpy ride over the course of the last few years. There's no question, as the economy's done better, they are experiencing this softer landing environment, but they definitely have more headwinds than the larger enterprises across the country.
If the economy has hit that soft landing position, David, what is your outlook for that bread and butter investment banking business over the next 6 months? Of course, a lot of excitement around the ARM deal, Instacart, you name it. So we're starting to see some big names in that private market come to public market, or at least very soon. Do you see that IPO market and the investment banking business starting to turn around?
Well, we've been through a really tough year for capital markets activity. We went from a very robust environment in 2021 to obviously a much different environment after the war in Ukraine started. And obviously, very, very high rampant inflation, a very significant change in posture from the Federal Reserve. If you go back and look at Powell's comments, a year ago at Jackson Hole, that decreased confidence significantly. And of course, that closed down M&A activity and capital markets activity. And that activity really in the first half of this year was pretty anemic. we are starting to see a pickup in activity. As you mentioned, there are some very significant IPOs that are in the market this week. The ARM IPO is progressing nicely, and I do believe that if these IPOs go well, that kind of creates a virtuous cycle of bringing some of the other IPOs that are in the wings waiting to market. And so I do see a pickup in capital markets activity during the course of the fall. I can't say that we'll get back to what normalized levels are, but we're really coming off of, zero activity. And so we're encouraged by what we see. And obviously an environment with more capital markets activity is a good environment for Goldman Sachs, given our position in those businesses.
That was our executive editor, Brian Sozzi, speaking with Goldman Sachs CEO David Solomon. We've got more coming up. Stay tuned. You're watching Yahoo Finance. We keep talking about the student loan repayments coming back. I mean, this is something we've been looking ahead to. It's finally going to be happening as of October. How much of an effect is it really going to have?
I think it's one of those things that's just another data point when it comes to the health of the consumer, and another reason why we could see volatility going into the end of this year. If inflation proves to be stickier, if we start to see more of a deterioration in the employment backdrop, then you're going to see consumers making the decisions that they've been making all year in terms of the nice to have versus need to have, and they're going to focus more on the need to have.
Federal student loan payments are set to resume on October 1st after a 3-year pause. Interest on these loans already began accruing at the beginning of the month, and millions of Americans are looking for some relief as they face years of payments and thousands of dollars of debt. Joining us now, United States Undersecretary of Education James Quall and Yahoo Finance reporter Rhonda Lee, who covers this very closely. Mr. Undersecretary, as we look at this repayments finally beginning once again, what do debtors need to know? What do people need to be aware of?
Well, Congress did end the student loan payment pause. Bills will be going out as payments are due in October. And we're really encouraging people to take a look at all of the affordable repayment options. We've created the SAVE plan, which is the most affordable repayment plan ever. We already have 4 million people in it. And we've also worked really hard to fix the loan forgiveness programs we've offered, like public service loan forgiveness. In total, we've identified 3.5 million people for loan forgiveness. So come to studentaid.gov and take a look at what options are available to you.
Undersecretary, just wanted to talk about FAFSA. This is most borrowers' first entry point when it comes to student loans. They're applying for colleges and then they fill out the free financial aid to figure out how much they need to pay, how much their parents need to contribute. Major changes happening to FAFSA coming out. Can you talk about that? What can borrowers expect? What's happening with FAFSA and when should they see that new application roll out?
Yeah, we're really excited about the changes to the FAFSA. We're implementing some bipartisan legislation that is going to make the process a lot simpler and easier for students and families. And it's also going to make the form more progressive. We're going to have more students who are eligible for Pell Grants. And so both of those things are going to be possible when we launch the new form later this year.
On the other side of this is just the cost of education and how much of not just a individual decision it is, but a household decision. So how is the administration also looking at making sure that those costs up front that families have to take into consideration and, for the sake of the conversation we're having right now, go into an extreme amount of debt over as well?
Yeah, you're absolutely right. We see college costs now. It's not just an issue for a student, but it's an issue for their families. Oftentimes, people who are still repaying their student loans are struggling to pay for their children's education, struggling to start a business or start a home. So this really is an issue, college costs, that affects families and communities and really the economy as a whole. We've worked really hard to bring down the cost of college going forward. Pell Grants are up by the largest amount in a decade. And we're also identifying those places that leave students with loans they can't afford to repay. A lot of them are for-profit colleges, and we have new rules coming out in the near future to hold them more accountable for that.
Speaking of the for-profits, stat is that 50% of the students who go into default are attendees of these for-profit schools. So can you go into a little bit about the Fresh Start program to get people out of default into good standing? And also let's talk to borrowers about what they need to be doing, contacting their loan servicers in order to be ready for October 1st.
Yeah, thank you for the question. So before the student loan pause, we had 1 million people a year defaulting on their student loans. These are disproportionately low-income students, students of color, first-generation students, and it can be very costly and very punitive if you have a loan and student loan in default status. So we have created the Fresh Start program that gives everyone an opportunity to start repayment coming out of the pause on a new beginning, just like all other students have. And we're asking people to call their student loan servicer or come to studentaid.gov and elect to participate in this program and choose a repayment plan. That's really important to do if you have a loan in default.
When you think about the longer term goal here for debt as it relates to higher education in this country, do you guys have a goal in terms of, do you want to reach a point where we have no students take on debt in order to get a higher education? I mean, how are you thinking about this in sort of bigger terms?
Yeah, well, one thing that we've made a lot of progress on is trying to clean up the student loan program and make it more affordable to repay your student loans, especially if you're in public service, you have persistently low income, you become disabled. The second step is investing in the upfront cost of college, and that's where doubling the Pell Grant, free community college come in. And those goals are ambitious, but they are achievable. The president pays for them within his budget. And then the third step is looking at where does all this unaffordable debt coming from? And a disproportionate share does come from for-profit colleges. We need to take a look at those programs that are leaving students with debts they can't afford to repay and figure out what a better option is there. Can we improve the value we're offering students, or do we need to finance those programs with scholarships or other means?
Our thanks to United States Undersecretary of Education, James Quall, and our very own Rhonda Lee. Thanks for joining us for our Student Loan Week.
You.
Thanks. We've got all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. What is the overall concern, or at least the acknowledgement that investors should be giving towards what's taking place in China right now?
You know, China is the second largest economy, so it's going to have ripple effects across the entire global economy. Whether or not it's, the fact that they're seeing weaker demand, they're seeing deflation happen, it all has to factor into how you see the global economy performing in the next 2, 3, 4 quarters.
Tensions continue to grow between car makers and the United Auto Workers Union. More than 100,000 U.S. auto workers are expected to go on strike this week if automakers Stellantis, General Motors, and Ford fail to meet worker demands. Yahoo Finance's Pras Subramanian has more on this story. Pras, all three proposals from the big three are in. So where do workers stand as the deadline for September 14th looms?
Yeah, so there's different progression with different automakers as to where they stand. So right now, it's going to be a lot of numbers here still. Let's start off with Stellantis. So Stellantis is the latest to submit their proposal on Friday. Here's what they said. They basically are doing a total of 4.5% in wage increases over the course of a contract, not right away. So that's a little different than what Ford and GM are offering. $6,000 one-time inflation protection payment there in the first year of the contract, and $4,500 in bonuses across 3 years. So they're spreading that other inflation or cost of living protection across the course of the contract. And then there's the big part, Brad, is there's supplemental, which are part-time workers, and also the in-progress workers who are going to become full-time, sort of fully vested union workers there. And what they want to do there is increase the part-time workers pay from about 16 bucks to 20 bucks an hour, so like a good 25% raise there. But then also for the in-progress employees, shorten that timeline from 6 to 8 years to get to that full tier sort of compensation. So that's what they're offering now. So as of this morning, Stellantis said that they have been negotiating with the UAW over the weekend. The UAW has sent them a counteroffer. They're looking at that now. They might release a second proposal this morning, at some point this morning.
And then we've got Ford and GM also.
Yeah.
How different are their proposals?
So big picture, GM and Ford are sort of offering more money up front as opposed to what Stellantis is offering. So in GM's case, about 16% up front, a $6,000 one-time inflation payment, another $5,000 inflation protection payment over the course of the contract, 3 to 4 years usually. And then for all employees, a $5,000 ratification bonus, in addition to sort of wage increases for part-time workers and in-progress workers that are sort of becoming full-time workers. So you see that happening. The UAW, for its part, called the GM proposal trash, but we do know that both sides, we're understood they both are still negotiating behind the scenes right now. So this is a lot of posturing here. Ford's proposal is pretty much the same as what GM's offering, just a little bit slight changes with compensation and bonuses in terms of also compensation stuff with.
So just quickly, what do we know then about the gap that currently exists between the automakers and the UAW in negotiating? How likely is it that we're going to get an agreement this week, bottom line?
Most people say that there's likely going to be a strike at one or all the automakers. So if you're looking at what the UAW has said publicly, they want a 40% increase in pay. They want tiered compensation to go away. They want cost of living increases to be sort of built into the package. And they want defined pension plan. Now, this is what they're saying. It doesn't mean they're going to get that or they really want all these things. They would love it, but they're not going to get it. So that's sort of the spread where we're at. Automakers talking about 15, 20% increases. They want 40. So that's where we're working in between there somewhere. I don't think we're going to get a defined pension plan. That's not going to happen, but we'll probably get some potential cost of living system built in for them, and maybe the tiered compensation, that sort of window kind of shrinking.
And we have talked at length about the economic impact if that strike does happen,
Right.
Thank you so much, Pras Subramanian, covering the strike for us if and when it does happen. All right, we are going to leave it there. Rochelle Akuvos got you for the next hour of trading as we see all three major averages in the green.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. It's a big week to set us up for year-end. Inflation data, Apple's latest product launch, and a big IPO from ARM all await us. The next few days will set the tone for investors. And when Jif met Twinkies, J.M. Smucker will buy Hostess Brands for $5.6 billion. We'll discuss a landmark deal in the food space and how the snacking economy is punching above its weight right now. Plus, student loan payments are set to resume, meaning a big change for borrowers and the economy. What are the key dates and what options do you have for refinancing? Yahoo Finance's Student Loans Smarter Strategies tells you what you need to know. But first, let's take a look at how the major indices are faring right now. As we can see here, starting with the Treasury yields, in positive territory here, the 5-year up about 0.6%, the 10-year also up in positive territory, up 0.8%, as we know that's a proxy for what we usually see with mortgage rates. Also take a look at the 30-year yield as well. That is up over 1% on the day as well. And checking in on the major indices here, we're seeing markets losing a bit of steam, but still in the green ahead of some key inflation prints this week. Well, this week will set the tone until the end of the year. The Consumer Price Index will be released on Wednesday. ARM's IPO is set to begin trading this week. And of course, Apple's newest iPhone will release this year. Now, Yahoo Finance reporter Ines Ferrer is here to tell us more about this big week ahead. Hey, Ines.
Hey, Rochelle, a lot to watch this week. Well, let's start out with that inflation print, which this Wednesday we are expected to be getting the August Consumer Price Index. The CPI is expected to increase by 0.6% from the prior month, an acceleration from July's 0.2%. Now, year over year, inflation is expected to jump to 3.6% versus 3.2% in July. Core CPI, which strips out food and energy, is expected to stay unchanged month over month. But of course, you could see a surprise to the upside, and that's due to energy prices. Oil, we have seen skyrocketing over the last couple of months, up about 25% since late June. So we are watching for that CPI print to come in a little bit hotter because of those oil prices. We're also taking a look at the IPO market this week as we are awaiting ARM's public debut. The British chip designer has a price range of $47 to $51 per share, valuing the company at up to $52 billion. And this is expected to be the biggest IPO of 2023. Meanwhile, also Instacart submitted an updated filing setting an offering price of between $26 and $28 per share. At the higher end of the range, Instacart is valued at $7.7 billion, and the online grocery delivery company will be raising about $616 million in its public offering. Look, these debuts are going to be really testing the IPO market after it essentially froze after 2020, 2021. We saw a peak during the pandemic of IPOs, of SPACs, and with that tighter monetary policy that we have seen over the last year, we've seen the IPO market basically freeze. So we will see how the reception is for ARM this week. Also, Rochelle?
Well, Inez, just to hop in here, we're coming up on one of the most exciting times of the year, of course, for Apple. Its new product unveiling. What can we expect from them?
Yeah, the iPhone 15, that lineup is expected, including the iPhone 15 Pro and Pro Max. So if you're an Apple buff, you will want to pay attention to this. Apple will reportedly have a new display technology, also new titanium casings that could reduce the weight. And also, Apple is reportedly doing away with the physical ringer button that's on the left-hand side of the phone for the 15 Pro line. Instead, it will have a Pro programmable button, which is going to be able to handle like a number of tasks, including launching the camera. But the biggest change is a switch to USB-C charging ports. And that's, according to Bloomberg, European tech regulations call for companies to use USB-C chargers that way. That's across the board in order to reduce e-waste. So Apple already uses USB-C for its iPad Pros and the Mac lines of products. So this will be a change, a pretty significant change when it comes to the iPhone 15. Rochelle?
Indeed, and that's the same charger that we use for Samsung. So as an Android person, I might be doing a little bit of hate watching on this Apple announcement, but we'll see. I'm sure I'll be a little bit jealous. A big thank you for that update, Ines Ferre, there for us.
Thank you.
Well, Yahoo Finance is taking a closer look at the Magnificent Seven and what investors should keep in mind with the biggest names in tech. Today, of course, the focus is Apple. Reports last week of China banning government employees from using iPhones at work sent shares of the company spiraling. They saw $200 billion slashed from its market cap in 48 hours last week. More on the future of Apple. Yahoo Finance senior reporter Ali Garfinkel has been watching all the action. Hey, Ali.
Hi, Rochelle. There are no shortage of headlines coming out about Apple right now, right? You've got the iPhone bans, you've got the launch of the iPhone 15, and beyond that, you have slowing growth, supply chain shenanigans. Apple has everything right now. But in the midst of that kind of chaos, I think it's a really good time to zoom out and say, what's really going on with this company? Long term, what are we really looking at? And one of the things that keeps coming up over and over again as I talk to these Wall Street analysts is, though no one has doubts about Apple being a fantastic company, there are doubts about what kind of company it is. Now, what do I mean by that? Essentially, it amounts to this question. Is Apple a growth stock or a value stock at this point? And it's complicated. Apple's in this transitional moment, right? They are the largest company in the world. They are an almost $3 trillion company, and they are a tech company. So there is unequivocally this premium on growth from management. That said, that growth hasn't really been happening, right? Look at last quarter, right? Apple's Mac sales declined by about 31% versus last year. Total net sales slid about 2.5%, and revenue fell for the third straight quarter. And remember, iPhone sales account for half of that revenue. So the question about Apple really is, where is the next phase of growth going to come from? There are a couple of ideas. Emerging markets is one. India is a place Apple has invested substantially in. Some people would say China, even though that's an incredibly dicey thought at this exact moment, I would say. The other one is the AI wave. Some analysts absolutely believe Apple is set up to ride the AI wave. They have invested in conversational AI increasingly, reportedly, but it is still early days on both counts.
So then when we're sort of stuck in this value stock versus growth stock conundrum here, then what should investors do with Apple stock right now?
You know, there's no one size fits all, Rochelle, and Wall Street is relatively bullish, I will say. Currently, the analyst Wall Street recommendations break down to 35 buys, 14 holds, and 4 sales. But for you out there, if you're thinking about buying Apple stock, I sort of have a question for you, which is, what do you believe will happen next? Do you believe they've just gotten too big and growth will have to slow from here? Or do you think they'll be able to ride that next wave? We've seen that legacy tech companies can do it. Microsoft certainly has this year. I want to read to you something that one of my sources said to me because I thought it was a really smart framing of this opinion. Are you paying for their dominance? Are you paying for their staying power? Or are you paying for their growth? Those are all different calculations. So I ask you, if you buy Apple, what are you paying for?
Indeed, got that metaphysical question there, and also obviously a question that a lot of investors need to figure out for themselves, and sort of what the long-term vision is for Apple. There you go. So you get me. Our very own Ali Garfinkel, thank you so much. Well, investors are awaiting a big week of data. Consumer and producer prices crossed this Wednesday and Thursday respectively, giving the last insight into inflation ahead of next week's Fed meeting. So how can we expect the news to impact markets? Well, joining us now is John Lynch, Comerica Wealth Management CIO. Thank you so much for joining us this morning. So John, for investors trying to make sense of what to do basically in this holding period before we actually hear word from the Fed, given what we're seeing with PPI and CPI data that's been pretty stubbornly strong here, what should investors make of this?
Thank you, Rochelle. Good morning. I think the CPI report will be more important than the wholesale or the PPI measure coming out on Thursday. The wholesale prices have come down considerably, and I think that's kind of factored into the markets. But on the consumer price, the consensus estimate is up significantly from prior month's data. We had 0.2% in July, and now we're looking at 0.6%. So for the month of August. So I think that's something that maybe the market hasn't really appreciated yet. But really beyond this number, the Fed meets next week, right? So there'll be a lot of concern. I think a hike next week is pretty much off the table, but November's still in play. But I do think investors need to appreciate that the year-over-year comparisons on inflation is something that I don't think has really been fully embraced. Even if we just maintained a July pace, right, of 0.2%, by year end, we will still have a print of 4% year over year. So even though inflation is steady in that analysis, right, at 0.2%, the year over year number would be 4%, which would suggest inflation is accelerating. So there will be some cross currents that investors need to deal with regarding inflation over the next few months.
And certainly as we look at some of the signals, I mean, looking at the 10-year Treasury, I mean, you expect another 50 basis point increase likely in the coming weeks or months. What do you think is going to drive that next leg up from where we already are?
Yeah, thank you for bringing that up, because the market discourse now is the Fed's done or close to done. And my message to investors is that the market is not done, because for several reasons on the 10-year Treasury with market interest rates rising. First and foremost, if you just look at the technical chart on the 10-year Treasury, given where we were from the low in March to the high most recently, it does appear that 4.75 to 5% is in play on a technical basis. But secondly, on a fundamental basis, you no longer have, if you will, the size buying that we've seen from the Japanese, from the Chinese, and certainly from the Federal Reserve now that we're fully engaged in a quantitative tightening standpoint. So you have three big buyers that are no longer there. That is on top of my third point, where Treasury, as you know, announced a 30% increase in funding from where we thought we were, 750 billion, call it, for the fiscal quarter ending in September. Now it's north of $1 trillion. So we have more supply with fewer buyers. And then finally, just looking at the relative comparison between the 10-year Treasury and CPI on a headline number, the 10-year typically trades about a 200 basis point premium to CPI. So that also would suggest, even on a low print number for this Wednesday, the 10-year still could approach that 4.75 to 5% within the next several weeks, couple of months.
So then, in terms of best ways to navigate this uncertainty, especially when you think of the domino effect, if we are looking at that 10-year being the marker of what's to come, what are your expectations?
Sure, it's always a challenge with the markets, right, with rising rates. And I don't think equity investors, we have, the money supply is still so strong, and there's still such a preponderance of momentum in the growth space. I do think rising rates with a Fed that will likely maintain tight policy through the first half of next year. I think the expectations for 4 hikes, or for 4 cuts next year are overdone. But I do think investors should reassess their portfolios. I still believe, now I've been wrong for months on this call, but I still like value over growth in an interest rate environment where you see the 10-year approaching 5%. So it's a slight overweight, but nonetheless, you talked about the Magnificent Seven earlier. There are 493 other companies in the S&P 500 that I think investors should be diversified. And we're starting to see momentum in energy, and that's coming at the expense of consumer discretionary. We're starting to see firming in the industrial space. And I also like healthcare, if you want to think about energy and healthcare from a barbell risk strategy, if you will, for healthcare's defensive strategies.
We do appreciate you joining us with your insights there. John Lynch, Comerica Wealth Management CIO. Appreciate you joining us this morning.
Thank you, Rochelle.
All right, all your markets actions still ahead. Stay tuned. You're watching Yahoo Finance.
What is the thing that you most want to avoid in the market right now?
I would say market timing. There's a lot of dynamics about either being all in, all out, and look at what's happened year to date. I don't think anyone was anticipating the rally that we've seen in US equities. So this idea of just being balanced, staying invested, staying diversified, and not trying to time these markets.
What is the thing?
Let's do a check of the market sponsored by Tasty Trade. Still looking at green across the board, although the Dow and the S&P bouncing around session lows at the moment. The Dow up about 20 points on the day. The S&P 500 there up about 1/3%. Consumer discretionary leading the charge. Energy the laggard there. The tech-heavy Nasdaq there up about 0.6% or 81 points. Tesla, Meta and Amazon helping lift that index. Well, 22 years ago today, Wall Street firm Cantor Fitzgerald lost 658 employees in the September 11th attacks. In the wake of the tragedy, the Cantor Fitzgerald Relief Fund was born to assist those affected by 9/11 and other worthy causes worldwide. To date, the organization has distributed over $369 million in aid to worthy causes. Today, celebrity guests and Cantor Fitzgerald employees will come together to remember the lives lost, and all revenue from trading today will be donated to charity. Howard Lutnick is Cantor Fitzgerald's CEO. He joins me now alongside Yahoo Finance's Diane King-Hall. A big thank you for joining us this morning on this day. So obviously the losses that Cantor Fitzgerald was under on 9/11 there, the biggest firm saw the biggest losses that day. How do you come from that position and that wake-up call for the financial community to where you've come now with the fund?
So we lost 658 people, but these were all our friends. I lost my brother, Gary. He was 36, my best friend. But that was true of everyone because the policy of the firm was, let's hire our friends. So you think you lost all those people. We've got to help those families. So the rallying cry that rebuilt this company was, you're going to come join us. We give away 25% of everything we make for the next 5 years, and we take care of these families. So we raised those families in those first 5 years $180 million. We paid health care for all 658 families. And that became the foundation on which Cantor Fitzgerald was built. And now all the people behind us, they're all waiving their days paid today. We turned it to taking care of 150 different charities around the world. We have celebrity ambassadors come in. Got Dave Portnoy behind me. We got Eli Manning, Matthew McConaughey. They're walking around the floor. You'll see like some tall people walking around, basketball players, Rangers. Everybody's here trying to make it an incredible place to raise money today.
We see you always have a video appearance every year. We do. We love it. We love it. It's just a signal of your firm's resilience, Howard. You and I have talked in the past, and my heart goes out to you with all the loss that you experienced, both personally and professionally. But I want to talk to you about both the resilience and how you got the celebrities involved in this event, and then just the goal and the impact you're trying to achieve in this year in particular.
So if you're going to raise money for charity, we want to take care of our employees' charities, customers' charities. So what we did is, if everyone's going to waive their day's pay, and everybody at Cantor Fitzgerald waives their day's pay, I don't want them going home and telling their kids that they worked their tail off today and the money went to somebody else. So we invite celebrity ambassadors in, and gentleman takes a picture with Eli and Peyton Manning, and he goes home and shows his kids, look, and his kids think, Dad, you have like the coolest job, and that's the idea, to make the energy here very positive. It's a very, very tough day for me, but all these employees behind us. Remember, Cantor Fitzgerald had 2,000 employees on 9/11. We went down to, we started the new year of 2002 with just about 1,000, and now we have 15,000 around the world. We've got Cantor Fitzgerald. We've got BGC, the world's most important wholesale financial service company. And we've got Newmark, which is now liquidating the Signature Bank loans now. So the company is doing great things, but all of them are donating their money to charity today to make it a great day, and we can take care of so many people. Bringing everybody together and make something positive on the toughest day.
And Howard, you have an entire generation who didn't have to live through this experience. What sort of legacy do you want to pass on through the work that you're doing at the fund and to the financial community as well? You have a lot of graduates who are going to be perhaps coming into the financial industry who really didn't live through any of this.
So I'm walking on the floor today, walking over to sit in front of the camera, and a young lady comes over and says hello. She was Matt Leonard's daughter. So one of our lawyers who we lost on September 11th, she was 6 months old at that time. But now she's joining us as part of, we offer a job to any kid of anybody we lost. So we've got to bring them in, show them what it's like, show them how you can care and how you can engage your community and your families all together. So the idea is keep 9/11 alive, but do it in a very strong and very positive way. Get the whole Wall Street community, the whole financial service community engaged, and show them that we can do something great, even in the shadow of something terrible. And that gets young people involved. You got Dave Portnoy with his 4.5 million followers on Instagram, tweeting out his trades. Charlize Theron, she did a $5.2 billion U.S. Treasury trade today. So that's pretty cool. Pretty cool.
Howard, how much are you looking to raise this year through the Charity Day? And what would you like the legacy of Cantor Fitzgerald to be?
So last year, we raised $12 million today. So now today's a Monday, and Mondays are not as busy. As you said, the S&P is sort of up like 1/3%, not particularly exciting. But hopefully we'll get the world engaged and excited. We start this in Asia, and then we do it in London, and then we finish it here. So I think we're running about the same as last year. So I hope we raise $12 million, which will be good on a Monday. That's pretty good. And the legacy of Cantor Fitzgerald, you know, we suffered the worst loss. I mean, you can't imagine losing all the people who produce money for your company. That's not possible, right? It's not even a concept. It's not on the menu. And so for us to rebuild and to do it with grace and taking care of the families and taking care of so many others would show that our resilience and the resilience of America is positive, it's uplifting, it's strong, and you're never, ever going to keep it down.
All right. I mean, you're doing absolutely incredible work here, and I wish you all the best of success in building money for this fund. Hopefully other Wall Street firms take note of the incredible work that you're doing as well. Cantor Fitzgerald CEO Howard Lutnick and Yahoo Finance's own Diane Kinghall. A big thank you to you both.
All right.
Thanks for all your support. We really, really appreciate it. Thanks.
We appreciate you.
You're very, very welcome. All right, shifting gears now. Shares of both Disney and Charter pushing higher this morning after the news that the blackout fight between the two is over. The companies are expected to reach a deal that would allow millions of Charter cable customers to watch Monday Night Football, which airs on Disney's ESPN. Now, the dispute has been going on since late August after negotiations broke down, leaving over 14 million Charter customers without Disney TV channels, including ESPN, FX, and the Disney Channel. Now, following the blackout, Disney said Hulu Plus live TV signups were more than 60% higher than expected. Now, hours after the blackout started, Charter executives pushed for a revamped deal with Disney that would give Spectrum pay TV customers free access to Disney's ad-supported streaming apps. Disney responded that its streaming and TV networks weren't equal because of the original live TV content and its multi-billion-dollar investments in exclusive streaming content. Terms of the deal haven't been released yet, but all media stocks are up on that news. All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Are your clients paying attention to politics yet, particularly presidential politics?
Starting. It is starting. So the questions have been coming in, I would say really over the past couple of weeks, and really just trying to anticipate what does this mean from an investment standpoint. And our view is trading around politics is a very dangerous game. So don't let politics drive your portfolio. Let the markets and the economy drive it.
Capping a heavy news week, Friday is also triple witching options expiration, when equity index futures for the S&P 500, Nasdaq and the Dow expire alongside cash options on stock and indices. But this month, call options, which are used by options buyers to bet on higher stock prices, are decidedly not in favor. Yahoo Finance's Jared Blickering has those details. Hey, Jared.
Thank you, Rochelle. And don't call it quad witch. It used to be quadruple options expiration, but it's only triple now. There are no single stock futures anymore. This chart goes all the way back to January of 2021, right before the height of the GameStop craze there. And this tracks total net call volume. And you can see these spikes here. This is when calls were much more in favor. In fact, they were so in favor that they were driving the price. They were forcing options dealers to buy the underlying. They were forcing the price of stocks like Apple and Tesla decidedly higher. Well, last year, 2022, not surprisingly, we saw a bunch of dips. And although this latest dip is not as low as the others, it does show that call options not in favor. And that's because the mega caps, a lot of those growth stocks that we've been tracking all this year, have flagged a bit in the month of August, at least since the month of August. But what is in store for options expiration this Friday? I actually showed calculated the one-day returns on OPEX days going all the way back to 2015, and you can see the trend is decidedly down, even through some of these really big bull markets. This gray here is the S&P 500 ETF SPY. So you can see it's actually sideways, tracked sideways over the last, let's call that 6 to 8 months here. So we'll have to see what comes this Friday. But I also want to point out VIX seasonality favors a big spike in September and October, and we know that when the fear gauge spikes, that generally means equities are rolling over. Sometimes they crash as well. So we could be in store for another moment like that this September or October. In fact, we did have a mini crash, just a small one, last October, and I'm going to show you what the VIX was doing back then. Here's a 1 year. This is a year-to-date chart. If I show the 1 year, you can see that peak in early October. This actually set up that mid-October buy that was the basis of the bull run that we've had so far. So with crashes come opportunity, and like I said, we don't necessarily have to have a crash, but these next 2 months does seem more likely than usual. Guys?
We'll certainly be keeping track of that. Appreciate you, as always, Jared Blickery there for us. Well, America is turning into a nation of snackers. It's a big lifestyle in the US. Take a look at these numbers. 49% of consumers enjoy 3 or more tasty treats a day. And those numbers increasing 8% in the last 2 years. Yahoo Finance's Brooke De Palma is here to weigh in. So, Brooke, it's clear that the snacking economy is extremely valuable to consumer staple companies.
Good morning, Rochelle. That's right. All eyes on snacking this morning after the major acquisition of Twinkies parent company Hostess by SJM Smuckers. Now, of course, with that being said, we're seeing younger generations really drive growth when it comes to the snacking economy. According to a recent survey, 18 to 44-year-olds are leading the charge when it comes to snacking 3 times a day. Now, younger generations, as you can see here, really fueling that growth with 25 to 34-year-olds saying that they snack 3 times a day. That's a majority of them coming in at 68%. Now, Hostess executives say that consumers are taking more of a balanced approach when it comes to snacking. They're saying that about 20%, they're saying that indulgent snacks are growing at a 20% rate faster than healthier occasion snacks, those healthier options. When it comes to that balanced approach, they're saying that the number of snacking occasions throughout the day is growing as well, with consumers sort of picking and choosing more times throughout the day that they want to grab that Twinkie perhaps. And so with that being said, we saw in Hostess' latest quarter results that they considered themselves a pure play snacking company. And while demand dropped slightly due to higher prices, they did get a boost in revenue last quarter. Executives have since said that they paused price hikes, hoping to once again fuel growth in snacking. And James Smucker also said that revenue growth, and that was boosted by a 13% increase of volume and price mix. And so certainly other names to watch in that snacking price include Hershey's, General Mills, as well as Mondelez. And so all snacking we'll be watching very closely, especially after that acquisition.
I mean, and you have to imagine between the stress of the pandemic and everything else, you've got stress eating, comfort eating. It makes sense that the snacks would be doing well. Now, Brooke, you also spoke to J.M. Smucker's CEO, Mark Smucker, on the company's acquisition of Twinkies maker Hostess Brands. So then what will this mean for Smucker's portfolio?
Right, Rochelle. Well, that deal coming in at $5.6 billion. Now, it's expected to close in early January at the end of Smucker's fiscal third quarter. And Mark Smucker, J.M. Smucker's CEO, jumping right to what this means when asked about his portfolio, jumping right to snacking, saying, quote, it expands our access to snacking occasion like different times a day. People are looking for a sweet snack versus a salty snack versus a protein-based snack. This obviously expands us into that sweet sort of reward, if you will, kind of snack. Now, in addition to that, other assets that he said will add to the portfolio is better access for convenience for J.M. Smucker. Think those Uncrustables, an opportunity there. Whereas on the flip side, for Hostess, Mark believes that this will present Hostess with an opportunity for a better middle aisle of retail stores that J.M. Smucker knows very well, especially with that assortment of jams. And once again, in the frozen aisle with those Uncrustables, which is nearly an $800 million company. In addition to that, J.M. Smucker also weighing in that this provides solid innovation capabilities that both brands bring to the table. And so, of course, I had to ask if we'll see a jelly-infused donut. He said, never say never. And lastly, in addition to that, he said that he hopes to take this opportunity to amplify Hostess brand's consumer marketing. And so certainly, consumers can expect more marketing play when it comes to getting Twinkies in front of consumers, similar to what we've seen with that mega growth of Uncrustables. But both here, major snacking companies really looking to get in front of consumers as, once again, people are snacking more than perhaps pre-COVID.
Indeed. Even looking at the stock prices, I mean, we're seeing both Hostess and J.M. Smucker now on Yahoo Finance's trending ticker. J.M. Smucker, though, under some pressure, but Hostess at least seeing some gains there, up almost 20% on the day. A big thank you there to our very own Brooke De Palma. Thanks so much. All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
We keep talking about the student loan repayments coming back. I mean, this is something we've been looking ahead to. It's finally going to be happening as of October. How much of an effect is it really going to have?
I think it's one of those things that's just another data point when it comes to the health of the consumer, and another reason why we could see volatility going into the end of this year. If inflation proves to be stickier, if we start to see more of a deterioration in the employment backdrop, then you're going to see consumers making the decisions that they've been making all year in terms of the nice to have versus need to have, and they're going to focus more on the need to have.
Americans have a staggering $1.7 trillion in student debt. Now, this number can be anxiety-inducing for borrowers, which is why the conversation around loan forgiveness and cancellation has become so prevalent. But what loans are eligible for forgiveness, and what are the different types of student loans? Well, joining us now to break that down as part of our Student Loan Week is Yahoo Finance reporter Rhonda Lee. Good to see you, Rhonda. So help us break this down.
No problem. So the first thing we want to talk about is financial literacy. And the bigger problem is that a lot of times borrowers are taking out this debt not understanding what's happening. They don't understand the difference between federal student loans versus private student loans. And just to educate our readers, 92% of student loan debt is federal student loan. The other 8% is private student loans. Here's the big difference. When you have your federal student loans, typically they are in deferment while you are in school, so you don't start your payments until after you graduate. When it comes to private student loans, you can possibly be required to pay on those while you're in school. The other thing you need to know is that with the federal student loans, there is a fixed rate. With your private student loans, there can be a fixed or variable rate, which means that 1 month your payments might be lower, but as interest rates go up, which we've seen over the past 9 months, then your payment increases. I saw this a lot in 2008 when we had the crash, and people who had a $600 a month payment with their private student loan lender, it jumped up to $1,300. The other thing you really want to consider when you're talking about federal student loans and getting student loans is that when it comes to federal student loans, your loans, if you unfortunately die while you have your loans, your debt dies with you with federal debt. If you have private student loans and you die, that debt passes on to your estate, which means that your parents, your spouse, or your heirs will take on that debt. So these are conversations that need to happen, and people need to understand what's happening with their loans before they get into them, as they're looking at their FAFSA application, trying to decide whether or not the parents want to get the Parent Plus loan. Another reason why you want to make sure you are taking a look into this. With your federal student loans, there are several ways to do repayment. One of the great things about them is the income-driven repayment plans. IDR. If you have federal student loans, you want to know about IDR. So that with IDR, if you have been in repayment for 20 to 25 years, after 20 to 25 years, the remaining balance is forgiven or discharged. Also, if you have federal student loans and you're a teacher, you're a doctor, or you work in public service, you're firefighter, after 10 years of repayment, your loans are discharged. If you have private student loans, that is not the case, or if you refinance your federal loans into a private loan, you miss out on those options. So when you're looking into this, be sure you're looking at what happens after you take out those loans, before you sign on them, because I've run into too many borrowers who were doctors, worked in public service, and they thought they were eligible for public service loan forgiveness, but they refied those federal loans into private loans, and they cannot get the benefit of that. So those are just things that parents, borrowers need to consider before they sign on a dotted line. Take the time to ask the questions.
And Rhonda, you raise a very good point there, especially people looking at sort of the front end of the loan, not really thinking about the consequences of things, as you mentioned there, of what they could be missing out if they refinance. Appreciate you breaking that down for us, our very own Rhonda Lee. Thank you as always. Well, federal student loan payments are set to resume on October 1st after a 3-year pause. Parents and students have so many questions regarding current loans and what they can expect from federal financial aid in the future. Well, joining us now as part of our Student Loan Week is Justin Drager, the National Association of Student Financial Aid Administrators President and CEO. Good to have you on. I'm sure it's a very busy week for you, especially at the moment. So first of all, for students who are seeing this start to kick in, they're looking down the road at October, what should be in their loan repayment toolkit when they're trying to manage this debt?
Yeah, the first thing we would advise any student or family that's managing student loan debt is not to wait. The time to be thinking about repaying your student loan debt is today, not waiting until the last moment. So reaching out, contacting your federal student loan servicer, logging into your account, and thinking about making payment arrangements now. As was just explained in the previous segment, there are payment options available to students and families that are struggling, including deferments, forbearances, and income-driven repayment plans, including a new one by the Department of Education called the SAVE Plan. that will save students and families a significant amount of money if their income is not in a place where they can make payments.
And obviously, this can be very overwhelming when you're trying to figure out which plans you qualify for. How should people approach this? I mean, you have the HEROES Act, you have Biden's SAVE plan, wondering whether or not you qualify. How do you sort of work your way through it to put yourself in the best position for your particular loan?
Yeah, you really nailed it. It's unfortunately, there are lots of benefits with federal student loans. Unfortunately, because it is a federal loan program, there's lots of bureaucracy and complexity around it. And it can be difficult to navigate all of the different options and benefits that are available. The good news is that on studentaid.gov, if borrowers log into their accounts, they can use a federal loan calculator to determine exactly which repayment plan will most benefit them. They can try to contact their federal student loan servicer. And because, as you pointed out, federal student loans are being onboarded for 20 million borrowers after a 3.5-year pause. Wait times are expected to be significant. Federal student aid is giving borrowers a significant time to on-ramp. So if they're not able to get through, they do have a significant amount of time to try to get through and get their payments figured out. They can also reach out to their college or university's financial aid office. They may have left school, but those financial aid offices are there to try to help students figure out their repayment options even after they've left.
And some people might not know, but your organization, the member institutions, serve 9 out of every 10 undergraduate students in the United States. So at some point, your organization, connects with these students here. So if you're a financial aid administrator, how are you sort of training and getting used to some of these changes and some of the questions that are going to be coming at some of these administrators?
Right. It's a very complex environment. It gets more complex every single year, but financial aid offices have to be compliant and administratively capable to participate in all of these programs. So if you're attending an institution, which most do in the United States, if you're an accredited institution that's offering federal Pell Grants or federal student loans or federal work study, you have signed up and made an agreement with the United States government that you are going to stay up to date on all federal regulations and be compliant, and that you are going to help your students and borrowers navigate these complex systems even after they've left. And in fact, schools are held accountable for how many borrowers end up defaulting on their student loans. So schools have a vested interest, not just altruistically, but a financial interest in helping students navigate their loans successfully and repay them successfully.
And then specifically looking at FAFSA, how do those changes impact the financial aid administrators?
Yeah, financial aid administrators are helping students navigate some really complex changes that'll begin in the 24-25 year, which is a year from now. We just started up the 23-24 year, but the new FAFSA is due out this next December. So if you're a parent of a high school senior right now, and you're thinking about filling out the free application for federal student aid, that FAFSA will be coming out this December. And there will be some changes this year to federal methodology, which means how we are calculating financial need and how financial aid offices then are applying those calculations to determine whether families qualify for federal Pell Grants, work study, and the types of loans that they'll qualify for. Really, to qualify for financial aid, and when we say financial aid, we mean all of it: grants, scholarships, work, and loans. Financial aid offices need two things. They need to know how much it's going to cost a family to go to college, and then they need to know how much financial need there is. And it all starts with the FAFSA. So families should be looking for that form to be available in the month of December, according to the U.S. Department of Education.
And Justin, just lastly, I want to ask you, obviously, some borrowers in default or perhaps planning to go into default if they just don't think they can make the payments. What role is your organization playing in administrating the Fresh Start program to really help borrowers and help them manage or get out of some of this debt?
If folks aren't familiar, the Department of Education announced just over a year ago this new program called Fresh Start, which gives every borrower who's in federal student loan default the opportunity to come out of default. They just need to contact their loan servicer or their collector and let them know they want this fresh start. If they go back to school, the process of going back to school will take them out of federal student loan default, and they will once again be eligible for federal student aid. Being in federal student loan default comes with a lot of negative consequences. And so at our institutions, which again, as you said, serve 9 out of 10 students enrolled in post-secondary education across this country, we really do everything in our power to try to help students avoid the awful consequences of student loan default. Thankfully, there are lots of options available to students, and we're here to try to help them every step of the way access all of the benefits that are available to them to stay out of student loan default.
We appreciate that. A lot of useful information there for people. Justin Drager, the National Association of Student Financial Aid Administrators, President and CEO. Thank you for your time this morning.
Thank you.
Well, modern technology is getting better every day, but is immortality possible? Well, some people in Silicon Valley seem to at least want to try. Yahoo Finance reporter Anjali Khemlani joins us to tell us more. Not sure if I want to live forever, but I'm interested in hearing what's going on here.
Yeah, it certainly is. It's something that has actually been taking place for quite a number of years, in the sense that, we've seen a lot of investment, a lot of Silicon Valley money, and just generally the billionaires of the world invest in trying to stay healthy for longer or defy age. And so added to that, we've seen recently the use of medical devices in that. So rather than, the next quick fix, we've seen, of course, the famous Kim Kardashian post last month in which she was promoting a full body scan that could run about $2,500, if not more in some places. Meanwhile, we also saw the frenzy and the celebrity rush behind the GLP-1 drugs in order to lose weight quickly. So, it oscillates between these quick fixes and some of the more longer term, more medically relevant products. And so what we've seen is that doctors have actually been looking at that and warning against sort of overutilization of some of these products, saying that they could even result in false positives. And that's where some of the concern comes in, as we see more and more investment into some of these miracle drugs or, ideas on how to keep healthy and stay healthy for longer. Things like tracking your sleep, healthier diets, going sober. All of these are movements that have been recently tracked to movements in that hub of Silicon Valley. So certainly it has its trickle-down effect, and that's why more and more you've seen that these health providers are concerned about that. And it should be an interesting sort of trend to continue to follow. As you know, it just continues to be an area of interest, and lots of discussions currently surrounding that, as you can see with various reports that are out there.
Indeed, you have to wonder about some of the costs of some of these things, how equitable it will be for everyone to be able to access some of these technologies. Appreciate you always getting us up to speed. Anjali Khemlani there for us. Well, last week, Yahoo Finance was all over the Goldman Sachs Tech Conference in San Francisco. We ended the week on a high with our executive editor, Brian Sozzi, speaking with Goldman Sachs CEO David Solomon. They touched on some much anticipated IPOs coming this month and the overall economic environment that we're living in. Brian Sozzi also took the opportunity to ask him about another big issue on investors' minds. Take a listen.
You do business in China. How concerned are you about these increasingly frayed tensions between these two big economic superpowers?
Well, there's no question that the bilateral relationship between the U.S. and China is something that's getting an awful lot of focus. I thought Secretary Raimondo did a terrific job in her visit, delivering some very, very important messages. We're significantly intertwined with China economically, yet from a strategic perspective and a security perspective, we have some very, very important things that we need to move forward to rebalance some of the relationship that we have with China. That obviously, that tension and some of those issues, as we work through them, those are headwinds to growth. China's economy at the moment definitely seems softer. That's something that we're attached to. If China catches a cold economically, we're probably going to feel some headwinds to economic activity because of that. So this is something that we all have to watch very closely. But I'm pleased, with what I see in the dialogue, but this is going to take some time to sort out.
1 year ago, I think it was about 1 year ago, we were talking about your latest 10,000 small businesses. I think it was a DC event. Now, fast forward to today, Goldman's a different business. You've pulled back in the consumer area, that more mass market is. Are you totally done in mass market? Do you ever see yourself maybe making a return there at some point once you've made some of these exits more recently?
Well, we built a very significant deposit platform in Marcus, and we continue to be in that business. We'll continue to take deposits from the mass market. Our Marcus platform has over $130 billion of government guaranteed digital deposits. We pay a very, very attractive rate, I think, to depositors in that platform. We still operate our credit card platforms, but we have scaled back some of our ambitions to be a larger direct-to-consumer platform. And we're really focused on our two principal businesses, our leading investment banking and markets business, which is about 70% of the firm, and our broad global asset and wealth management business, where we supervise $2.7 trillion of assets and are the fifth largest active asset manager in the world. We see an enormous growth opportunity for the firm in that area, and we're very focused on it. So that's where the lion's share of the firm's focus is at this point in time.
Would there ever be any interest in acquiring a smaller, getting into the community banking? If those acquisitions came up, certainly a lot of opportunities presented themselves earlier in the year. Is that something that would interest you as a way to more quickly get back into that space?
Where our focus, our strategy is clear. We articulated in our investor day in early February. We are focused on our investment banking and markets business, our primary muscle group. We have a leading franchise and the growth of our asset and wealth management business. There'll be other things that we touch on, but those are our primary focus at the moment. We have no plans to make an acquisition of a community bank or a banking institution at this point.
Fair enough. And David, there's been a lot of just, you saw this coming. There's been a lot of just strange stories about Goldman Sachs. And I think Yahoo Finance, that our community doesn't really care about any of this stuff. They want to know how your stock is going to do, how your financials are going to perform. But you as a leader, as you look back over the past few months, how have you changed? Do you see a better path to just sentiment on your leadership and the culture inside of Goldman Sachs?
Well, I wake up every day focused on Goldman Sachs. And I wake up every day thinking about, with my management team, my broad management team, and I'm very fortunate to work with an extraordinary management team across our management committee. I'm very focused on how we serve our clients, serve them with excellence, serve them with distinction, and how also we deliver for shareholders. We're coming up on 5 years this month. And if you look at this leadership team and the work we've done over the last 5 years, we've performed for our clients, we've grown our business, we've performed for shareholders. That's what our focus is on. And we tend to stay focused on those things. That's the discussion inside Goldman Sachs.
When you sit with investors and you sit with clients and you look them in the eye, do they still have confidence in a Goldman Sachs?
I think our clients have enormous confidence in Goldman Sachs. The feedback from our clients around Goldman Sachs and the work we do for them continues to be very, very strong. We wake up every day dedicated to serving our clients. I think we do it with excellence. We do it with distinction because of the extraordinary people that Goldman Sachs has all over the world. And so we feel very, very good about our client franchise, but we don't take it for granted. We invest in it every day. And I'm very confident that if we continue to serve our clients with distinction, Goldman Sachs will continue to grow and will continue to thrive, just as it has for the last 150 years.
That was Yahoo Finance's executive editor Brian Sozzi there speaking with Goldman Sachs CEO David Solomon. Well, that does it for now. I'm Rochelle Akufa. I'll be back with you 11 a.m. Eastern tomorrow. See you then.